point is how much of that money that went out the door of Credit Suisse in Q1 went in the door at UBS in Q1. I'd love to know that figure, because a lot of people at the same time, Tom, I think ultra high net worth individuals will have relationships at both banks to begin with, and I just wonder, Lisa, how that's developed in Q1.
Yeah, and whether this is sort of the logical place to go or whether they look for others to potentially diversify. Just want to give you this. We are getting a bunch of earnings throughout the morning. We just got Coca-Cola, and it came in with a pretty massive beat, with organic revenue for the first quarter coming in up 12% versus the estimate of 9.6%. The comparable EPS was 68 cents versus 65 cents. If you are one with pricing power, you can price upward and you can shrink it. Shrinkflation bothers me so much, I've got to say. That's it.
Do you want some time to complain about that?
No, I don't know if we have time.
You've got 20. Just give us an example.
It's like you think you're getting a certain thing, and then you're done right away. And it's just like, really?
It's called college tuition.
Equity futures right now, negative 0.2%. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
It's a really tricky time for the market because things are slowing.
Growth continues to slow, and that continues to pressure profits.
There's just a lot of great news priced into great companies right now.
If the consensus is talking about some sort of cliff dive moment in the second quarter, that's not happening.
This is ultimately really going to be, I think, a defining earnings season for winners and losers.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Getting your week started live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market negative 0.1% on the S&P 500. Your week is going to look a little something like this. After the close, a little bit later, we get First Republic. Terrible quarter. We'll put some numbers on that difficult quarter for that lender. Then later in the week, Google and Microsoft tomorrow. On Wednesday, Meta, Facebook, call it whatever you like. On Thursday, Amazon. Tom, on to next week, Apple.
On to next week, I'm going to steal from the Beatles. What a great album it was, 8 days a week. Maybe it's 9 days a week here to get out to Apple. But the whole continuum of this is great. And as we mentioned with Amazon in the last hour, even more so than the banks, each story is different. Like I'm off the Google story, and I'm absolutely fascinated how Google, maybe they've stumbled a little bit in the last year strategically. How do they frame the story forward? Just as one of the vignettes of it.
Cloud spend's going to be a big deal as well. Consumer price tolerance has been a theme for us as well over the last 2 years, I'd say, coming out of the pandemic with inflation as high as it has been. Lisa, getting another flavor of that this morning.
Well, I'm looking at Coca-Cola. That's probably what you can see, and that they beat expectations. Their earnings per share for the first quarter was 68 cents versus 65 cents. You can see that they beat on terms of how much their revenues increased, 12% versus less than 10%. How much is this? Because they are able to juice prices. They are able to shrink those cans that you used to get 8 ounces in, that now you get perhaps 4 ounces in, and you pay the same. Woo! I mean, honestly, you get all of these kinds of tweaks, and all of a sudden, you have earnings that are better than good. And you're seeing that in a number of big brands that are recognizable.
I'll let you pick up on that. She's fired up. Up 7% pre-pandemic, up 69%, make it 70% off the bottom of the pandemic. We're all going to die. No one's going to drink Coke. Boom.
Lisa, tell us what you really think.
Well, look, I just think that on one hand, when do you get the pushback for getting less and paying more? And you see that with the airlines, and you see that with certain consumer brands. And the reality is we're just not seeing it in a dramatic way yet, certainly in those certain categories, which is the reason why when everyone comes on and they say they're looking for companies with pricing power, that's what they're saying. Who is going to continue to be able to give less and demand more? And that's really what we're seeing.
You know, why do we do this economic babble, folks? It goes down to that banner on the radio right now.
Babble?
No, not you. No, on the banner on television right now. For those of you on radio, Coca-Cola first quarter adjusted organic revenue growth up 12%. I've never seen that number ever. And it's price in units, Elisa. And you're right. They've got, it seems they have maximum pricing power. When's it end?
You want to talk about real pricing power? LVMH. Can we get back to that headline from earlier on this morning? We have a $500 billion company in Europe, Tom. For the first time, $500 billion. It's the luxury player, LVMH, at more than 30% year to date.
I believe I saw in the blur, LVMH and Hermes together make up 21% of the CAC 40 market cap. Two stocks in luxury. I mean, this is not Apple where everybody's got an Apple phone and that. They make up 20, I believe it's 21% of CAC 40. I haven't said CAC 40. Ken Pruitt
When was the last time you
True
said
story, surveillance story. The
like
late, great Ken Pruitt. He and I used to argue. He'd be quoting the CAC 40. I go, Ken, nobody cares.
Yeah,
and he's like, Tom, they care about the CAC 40. So there it is.
LVMH is 13% of the CAC 40. 13.
You know, is this the new gold? Is this the new kind of hard asset that people put their money into? I just wonder how much this is really just being driven by revenge spending by people in China who suddenly can travel, who can suddenly go out. And I wonder if this is the main story behind some of this luxury spend, and the fact that people who saved all, who are in the upper income, gained a lot more during the pandemic and now have it to spend.
I thought it was interesting what Patrick Armstrong said on several levels from Plurimi Wealth around this name. He had this name, he basically rode the wave, then he sold it. And Tom, what's interesting about the why he sold it, more broadly, there's a theme here about upping quality and everyone's buying the same thing right now. That's one point. The second point was, once a company rallies this much, gets as large as it has done, he thinks there's going to be pressure on LVMH to make another big acquisition.
That's why they did the bond deal last week. I hear about this all the time, John. I go back, and I'm an amateur. This. Good morning to any number of people in New York that have helped me so much on luxury finance. It changed with Laura Piana. There was a day where not all, but part of Laura Piana was taken out, and no one in the industry's ever recovered by that I believe $1 billion transaction. What would they pay for you name it? I don't.
Well, we did try and name them on Friday. We missed you, Tom, because we went through a long list of luxury names that LVMH turned out already owned.
We couldn't find one for them to acquire.
Can you think of one that they don't own already?
Brunello, they don't. I checked after.
Okay.
Yeah.
Good to know.
I've never been in Brunello. I go by. It's too intimidating. It looks too expensive.
Brunello's very cool. Stealth wealth. Stealth wealth.
It's like
not my phrase.
Stealth wealth. That's very in right now.
It's a great phrase.
That's the way you dress on the weekends, isn't it?
Stealth
like no labels, no nothing.
Logos, no branding.
It's like
just,
a Succession thing.
If you know, you
know. Do you
know.
have the black base,
you know,
the Laura Piana? You have the Laura Piana baseball cap.
Let's move on. Your equity market looks like this. One of those Kendall Roy, Laura Piana black caps.
I got the San Diego Padres and the Red Sox, and Farrell's got Laura Piana going.
TK, this is so out of touch. Let's get to the equity market. We're negative 0.1%. In the bond market, we're shaping up as follows on treasuries. Yields come in 3 basis points. Lisa, 354 on a 10-year.
All right, just whipping through what we're looking at today. A quiet day ahead of some really big earnings. We get on the data front, Chicago Fed National Activity Index for March. That comes out at 8:30. U.S. Dallas Fed manufacturing activity for April. Do we see the same kind of resurgence that we saw in last week's PMIs? Then we get the change in a VIX index that people have been looking at. The SIBO Global Markets organization is creating a new one that might reflect the day-to-day volatility better. It's a one-day kind of volatility index. So far, we're not seeing any kind of indication from the benchmark VIX index that we're going to see an increase in volatility, which is a lot of people curious. And aftermarket, we get First Republic Bank earnings, which will perhaps give some indication of the stress over there.
Looking forward to those numbers a little bit later. Joining us now is Linda Dussel, Senior Vice President and Senior Equity Strategist at Federated Hermes. All looking ahead, Linda, to the tech earnings later on this week. I'd just like to start with what you're looking for and whether you expect those names to validate what we've seen so far in stock performance this year.
Yeah, well, thanks. Good morning. Thanks for having me today. And of course, you just mentioned the VIX being low, and one of the reasons the VIX has been low and has surprised everybody as versus the bond market index is because it's heavily weighted by these big names, many of which are big tech names. And the tech companies probably will do okay. Pretty much what we've seen so far this earnings season to date is better than feared. That's kind of what we're up against here now, is better than feared. And it's going to be very hard, I would think, for tech companies to give us earnings that would surprise enough to really move the stocks a lot, since it's a very crowded trade right now.
Linda, with immense respect for Federated's ability to be in the equity market, is this a bull market?
This is it's. I heard you say earlier today that we're in a bull market again. We believe we're still in a bear market, a mixed market. We think we've seen the worst of it. What we're in is a very slow-moving market now, 7 months in a range. And we continue to believe at Federated Hermes that we're going to be caught in a wide range that we're at the high end of right now, and probably for maybe another 9 to 12 months. We're looking at a 1% GDP this year and next. I've been thinking of a fun word to describe this is slowflation, slow growth, and inflation that's still going to be more stubborn than you would have liked. Tough to be a bull and tough to be a bear.
Linda, you talk about tech and how that's really led a lot of the indexes this year. If you take a look at the S&P market-weighted cap, you can see that it has outperformed the equal-weighted cap, I believe, for the quarter, going back for the first time since March of 2020. So I'm wondering, from your perspective, whether that has to reverse, whether that has to kind of right-size itself, or whether it has legs, because those behemoths are generating so much cash and, frankly, are still demonstrating a lot of sales.
Yeah, that's the problem. That it's tough to really make a big bet like that against behemoths that are so very doing so very, very well. It's great to see that at least they're joined by a staples company, Coca-Cola. The big behemoths will carry us through in kind of a slow growth type of an environment. It's just hard to really see a big increase in terms of the stock price when you're such a behemoth. What it does is it protects our economy from really what could be a bad recession, because they're in such great shape. And as you've already mentioned, there's still so very much money on the sidelines, and to include consumers' pockets, so they can pay up for those little cans of Coke.
Linda, have you noticed that everyone's saying the same thing? Let's play defense. And then they've got different definitions of what defense actually means. Some people say it's utilities, healthcare. Other people might say it's tech, mega cap tech. Other people might say it's luxury. LVMH over in Europe may be an example of that. Linda, what is defense to you?
Well, that's interesting. Yeah. What is a bank? A bank used to be a bank, and now a bank is a big tech stock, right? So to us, defense is it's kind of a turtle wins the race. It's a company. It's a stock, I should say, a company who is mature, who has a lot of market cap, a lot of cash to weather their way through difficult environments, and strong enough to give you a nice income stream. So, the way we...
I think we lost that connection there with Linda Dussel there, the very end of those comments of Federated Hermes. I think we understand where she was going with them, though, Tom.
Yeah.
What defense is to Linda and what defense is to ultimately other people.
How do you participate? This is inflammatory. How do you participate scared stiff? Okay, that was like X months ago. COVID,
sure.
The bottom. How do you participate now after recovery? And particularly, how do you participate now if you didn't participate in the bounce out of the pandemic? Those people have this immense immediate regret of what they missed in the recovery. And that's where you have to build an interior confidence to get in the market. Now, my answer is a triple leveraged all cash fund is a place for comfort
that's
right
the
now.
pitch. That's the pitch. There are all these interesting different points of tension, Lisa, that you and I have been touching on over the last week. The S&P 500 north of 4,000. The VIX, you mentioned the VIX, very low. CPI at 5%, let's call it. Unemployment at 3.5%, and a market pricing in cuts. Does something have to give? Can you reconcile all those things right now?
I personally cannot. There are people who say that a soft landing is still possible, and that could involve some sort of Fed rate cut. But if you believe this economy is stronger than it has been heading into other recessions, hard to see why the Fed would cut rates so aggressively this year.
On that topic, Drew Madison, MetLife, coming up in the next hour, about 50 minutes from now. Looking forward to that conversation. As we begin a brand new trading week, your equity market negative about 0.1%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy says the chamber will pass his $1.5 trillion debt ceiling increase this week. Still, Bloomberg's learned that McCarthy hasn't yet lined up all the votes he needs. McCarthy told Fox that President Biden must negotiate in order to avoid a U.S. default. Last week, the president called the Republican plan wacko. Another blow to France's President Macron and his push to enlist China's help on the war in Ukraine. China's ambassador to France told French TV that the former Soviet states don't have sovereign status as independent nations. Those comments triggered furious reactions, especially in the former Soviet bloc countries Estonia, Latvia, and Lithuania. China has now backtracked and says it respects the independence of those countries. In Sudan, the international effort to evacuate diplomats and other expatriates picked up over the weekend. The U.S. and U.K. militaries were set to airlift their officials to safety. Now, a temporary ceasefire between Sudan's army and the Rapid Support Forces militia that it has battled since April 15th appeared to have failed. The CEO of NBC Universal is leaving after admitting to an inappropriate relationship with an employee. In a statement after an investigation, Jeff Shell said that he deeply regrets the incident. He served as CEO since January 2020 and worked at NBC Universal parent Comcast for almost 2 decades. A replacement has not been announced. And it's the end of the line for Bed Bath & Beyond. The home goods chain will close all of its stores and liquidate inventory over the next 2 months. A turnaround attempt failed, leading the company to file for bankruptcy protection. Bed Bath & Beyond employs about 14,000 people in the U.S. and Puerto Rico. I'm Lisa Mateo. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Earnings season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first
First quarter results, impressive.
The revenue beat is amazing.
with exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The outline speaks for itself, and that's what moves markets.
Bloomberg Television and Radio, the fastest numbers and analysis you trust.
I cannot imagine someone in our conference that would want to go along with Biden's reckless spending. This is responsible. This is something that we have sat down for months, that everybody's had input in. We will hold a vote this week, and we will pass it, and we will send it to the Senate.
The repercussions of this are huge if you go forward as McCarthy wants. What will happen? You will literally see interest rates go up for mortgages, for loans. You're going to see the stock market plummet again.
That's the back and forth right now. House Speaker Kevin McCarthy on Fox News and Democratic strategist on the market, Senator Amy Klobuchar on CNN.
Oh,
Senator Klobuchar, global strategist down in Washington, D.C. on financial markets.
Did our team do that?
The team did that
captured
one.
It does great.
Yeah.
It really captures
Market strategy from politicians, Tom, never encouraging. I'm always uncomfortable. Both sides, I think what Speaker McCarthy did the other week was the same thing. Really sort of taunting markets with what might happen further down the road, trying to sort of get a reaction. And I remember when President Obama did the same thing, by the way. I remember the same thing, trying to encourage a reaction to force people over the finish line to agree to something.
Totally.
It's a game I don't think you really want to play.
They want to freak out so that they can say, look, this is a problem. We need to get on it. The American people are concerned. And if you don't have that empirical data of money is getting lost, then it becomes harder to get people.
2011 snuck up on me. I really did not see that coming. I believe it was 2011 where there was serious Washington angst. And it's not that I missed it, but it snuck up on me quickly. I wonder if that's where we are on this Monday morning.
Well, just to recap, Tom, you mentioned it in the last hour. Mike McKee talked about it last week. We've got some numbers on tax receipts for Treasury. They've fallen a bit below expectations in most places. Brings the ex-date forward, Tom, just a little bit.
Yeah, it does. What we're going to do is catch up with this right now and also catch up with the relationship transatlantic. John has really led on this coverage over the last number of weeks. Julie Norman joins us at the University College London UCL Center on U.S. politics. I'm really taken, Julie, by the distance across the Atlantic. Mr. Macron's been jetting around, avoiding domestic issues in France. And I saw in an Asian paper the idea of America as observer. What's the level of our isolationism right now? Is the United States of America going to be a global observer?
Well, I definitely don't think we're at that point yet, Tom, and I don't think China's read on us is quite right in that regard. Obviously, we've seen so far that the U.S. is playing a really key leadership role in Europe with everything going on in Ukraine, and moreover, in the coming years, is just going to need to be a leader in how the world and the U.S. engages with China. And of course, not all of Europe is going to go along with everything that the U.S. posits on that front, but the U.S. is not going to be stepping back on that, I think, regardless of who is in the White House after 2024.
What is the diplomatic stance right now that the U.S. needs to do? Are we patient and removed, or do we need to be assertive to rebuild relationships with Europe?
Yeah, I mean, it's a good question, Tom, because I think both parties have a will to have the U.S. be seen as a leader internationally. You don't want to be on the back foot. You don't want to be leading from behind, as is often the critique. But at the same time, there's often an unwillingness to put the resources behind that. And so that's often what we're seeing now from especially the more populist or MAGA wing of the Republican Party. The sense is it worth giving the amount of resources that the U.S. is currently doing to foreign policy that some would rather see used at home? But it's hard to not spend those resources and still have that same kind of leadership. So finding that balance is always a little politically tricky. I think Biden has obviously been very much leaning into that multilateral role. But again, if we have a change in the White House in 2 years, that's going to probably look a little bit different.
Julie, John was mentioning earlier this morning about this perhaps faux pas over the weekend in a French media interview with the Chinese ambassador talking about this potential for not recognizing former Soviet states and their statehood as much as the rest of the world does, and then trying to walk it back. What do you make of this?
Yeah, so that it did seem apparently like a faux pas, but again, one that you had to assume had some kind of strategy behind it. And I think right now we see China really trying to play different actors to their own benefit. I mean, that includes Russia, that includes the U.S., and that includes Europe. So I don't think some in China will be shy about saying things that they know will be provocative, that they know are going to push some in Europe the wrong way, if it can help them in some of their other aims right now with Russia, and then kind of walk it back when they need to as well. So I think there's a little bit of testing the waters going on there, but it certainly was a kind of a curious statement, especially at this point to say that. So I doubt that's one they'll be coming back to, but it could have just been a testing the water sort of move.
But Julie, you said something that's pretty compelling there, that they might be looking to curry favor with Russia. Can you get a sense of what the relationship is, how close this reliance is, not just Russia on China, but China on Russia for certain, whether it's strategic or if it's, just lines of trade kind of perspective?
Sure. Well, you said it there, Lisa. I mean, Russia obviously needs China much more than China needs Russia right now. So right now, China is kind of taking advantage of the moment. They know that Russia needs a market for oil, for cheap energy, for cheap exports, and so China's fully taking advantage of that. But I think this sort of, performative bromance relationship that we kind of see highlighted a lot, I think that's a bit overstated. I mean, to me, if the war in Ukraine, if Russia itself just becomes too much of an albatross for China, I don't think they're going to stay buddied up in that way, or again, they'll use it to their advantage. To me, China is very savvy about being very nimble with their relationships, taking advantage where they need to, but being able to pivot out and have lots of other options to turn to when it's not going in their direction.
We used to call things like this, I think, wolf warrior diplomacy out of China. Julie, is this a return of that?
Well, I'd say probably a little bit. I mean, right now, I think China is figuring out what their new diplomacy is going to look like. They've never really been at this kind of place where they have this much maneuverability, where they have this much strength, at the same time coupled with, again, coming out of COVID and trying to find their footing again. They have a lot of influence in a lot of parts of the world where they didn't before, and they just quite literally have many more options in front of them.
Great to catch up, Julie. As always, thank you. Julie Norman of UCL. If you are just tuning in and you're unaware of the events over the weekend, some remarks from the Chinese ambassador to France, to French TV over the weekend, that ex-Soviet states don't have sovereign status as independent nations, some uproar in obvious places across Europe, and the response this morning from the Foreign Ministry spokeswoman of China saying this: China respects the status of the former Soviet republics as sovereign countries after the Soviet Union's dissolution. Tom, it made a lot of headlines over the weekend.
No, it's a history lesson, and it goes to what Mr. Putin actually says. You have to look at what comes out of his mouth in these speeches, and they're always in Russian. Maybe it's lost in translation, but he harkens back, I would say, not late Soviet, not middle Soviet, but his blame on early Soviet Union expertise to an empire that he desires to honor and to rebuild. That's the Putin approach.
What Julie just said there, though, was that basically China is looking to curry favor with Russia, and that might have been an attempt to do that, to basically give a nod to them and say, actually, we're more on your side than it may seem, and then walk it back and say to the Western, perhaps Western nations, nations that are perhaps a little bit more upset about this alliance, saying, no, it was a slip of the tongue, and trying to play both sides, which gives you a sense of how tenuous this dance they're trying to do is.
They're currying favor, except Tim Cook's flying around in India, in China, creating that tension, and people in China want the latest Apple toy. I'd go, John, back to LVMH.
Sure.
What is made clear, Hong Kong is not where it is, and the Arnault family is going to move across all the major cities of China as far out as Pandaland, Chengdu. And they're going to go out to Chengdu and do the Louis Vuitton thing and the rest of it. And that's just as important to me as the geo-diplomacy.
Well, the Treasury Secretary put it pretty simply in the last week, didn't she? Yeah. When Janet Yellen turned around and said there will be no decoupling. You mentioned the Arnault family. The Arnault family does not want decoupling between Europe and China, that's for sure, based on their numbers.
A name Bloomberg Surveillance knows, Catherine Mann owns the high ground on this codependency and linkage of business China with business America. Does that trump all, not to use a pun?
Well, the link between business Europe and business China is going to be very, very tough to break. If indeed they even tried to sever it. Your equity market on the S&P 500, negative 0.1% to kick off a brand new trading week with a lot of earnings coming up.
Big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Slowly moving off the bottom this morning. Your equity market almost unchanged now on the S&P 500. Welcome to the show on TV and radio. This is Bloomberg Surveillance. We're negative, not even 0.1%, unchanged on the Nasdaq. Almost flat on the S&P 500. Outside of that, into the bond market, the 2-year yield north of 4% for the whole of last week. We stay there. We're down a couple of basis points to 416.28. Mentioned a few times the Fed goes quiet now, going into their Fed decision next week on Wednesday, teeing up a 25 basis point hike from the Federal Reserve, Tom. And then what?
I remember when it was quiet. You know, it was, there's only the Oracle.
You didn't
Alan
need a quiet
Greenspan
period,
spoke.
it was just quiet.
He's carrying a ham and cheese sandwich today.
The briefcase looks heavy. That kind of thing.
That was the mystery then. But you're right, John. I'm glad you mentioned. We got to get to May 3rd, and the jobs report is after that. Like we've got a GDP report now.
And before we get there, May 4th, the ECB with the euro north of 110, and everybody lining up to say the same thing about the European Central Bank. Lisa, the ECB is going to hike more than the Federal Reserve this year. Seems to be the direction of travel, which is why we've seen such a big move in a euro off the lows of the end of September last year.
Would you say that the most consensus trade right now is long euro dollar?
Yeah, and overweight European equities relative to US. Mislav Matejka at JP Morgan, they start their week writing about exactly that. And they finished with this line here. Here it is. We think the time to take profits on the trade is approaching, overweight Europe versus the US. And there are a lot of consensus trades out there, Lisa. We talked about the overweight of Europe versus the United States, and within the US, tech versus everything else, and you wonder what gives.
So the contrarian trades kind of start to emerge. Let's take a look at some specific names. We were talking about Coca-Cola and shrinking cans of soda, and they did report their first quarter organic revenue growth that dramatically surpassed expectations. I believe up about 12% in the quarter versus 9.6%. That was the estimate heading in. Those shares not up that much. I think that's interesting. 1.4% gain. Those shares are basically range bound so far this year, up only about 1%. So even some of these stalwart consumer names, not exactly doing gangbusters so far this year. UBS shares. This is interesting. The ADR is rising about 1.6% ahead of the open here. This comes on the heels of what we saw from Credit Suisse. John, you said this, that it doesn't seem like all that much, $69 billion of outflows relative to the sudden emergency rescue. Maybe this means that it'll be easier for UBS, Tom, to acquire Credit Suisse and make it work.
And they're tomorrow, and they're going to speak to the Swiss people, as Manus Cranny did in his bang-up report last hour. But the bottom line is, do they drop a bombshell tomorrow and say, here's our first layoff number, our first right-sizing number, our first rationalization number?
Sorry, Lisa, go on. No, please.
I would just say that the one bombshell, in my opinion, it would be if they gave you a new framework for how long it would take, and it's a lot shorter. If they might get a sense of that.
I think the PR story is going to be fascinating, because if their inflows look tremendous relative to Credit Suisse's outflows, and you put a number on Credit Suisse, what number was it in the end? I forget. So many weeks ago. No, I mean what they paid for it.
They paid $3 billion, and
whatever it was. Credit Suisse and UBS. UBS tomorrow has got to come across as the savior of Swiss banking, and not someone that got a mega deal from the regulator in Q1.
Just want to give you one more stock.
Sure.
Bed Bath & Beyond. They filed for
bankruptcy yesterday. Is it finally done? It's not a meme stock this morning?
It's not. Well, it's a meme in terms of how quickly it's going down. It's down 40% in pre-market trading. It is going to file for bankruptcy. It did file for bankruptcy, but it's also, this is really key, it's going to liquidate all of its stores and the Bye Baby shops. Well, but this is the issue, right? We also saw that with David's Bridal. They filed for bankruptcy.
What?
David's Bridal. It's a bridal
Is that
store,
like Susan's
shop.
Divorces?
Okay.
It's a great store.
All right, I'll let you discuss that in a second, but I do, go for it. But I do think that this is interesting. Also, if they don't find a buyer imminently, are going to close all their stores. This is different.
Can we pause here? And Ed's over here.
Susan's
Ed's over here shaking.
I'm almost crying.
So much. Can we pause here right now? This is really.
Leave.
How many kids sitting on a couch with a laptop lost money on this garbage doing the meme thing? I just wonder how much money was lost by people doing the meme thing with Bed Bath & Beyond. I just really wonder.
I just wonder if people are going to miss going in on those long, shelves just going up to the ceiling, covering all of the very industrial fixtures. That was their whole thing.
There's clearly some brand value in that name still, Tom.
Yeah, okay.
Be interested to see what happens with it.
Yeah, it'll be.
But I think a lot of people said the same thing about Toys R Us and
Blockbuster.
Yeah, so there you go.
Okay, well, let's jump forward here. We're going to do this at 60,000 feet with Ed El-Husseini, Senior Interest Rate Strategist at Columbia Threadneedle. And I love how he finds a more strategic tone to your reset for this tumultuous 2023. A 2023 on timing, scale, and scope. I love it. The magnitude and the timing all tied together. What is the timing, scale, and scope of Jerome Powell as he confronts the rest of the year?
It's a tough juncture. There's so many unknowns, and in some ways, if you look at what's happened over the course of the past 6 months, the degree of doubt around what's driving inflation, how quickly monetary policy from last year will finally constrict the economy, and now what's going to happen with the evolving banking shock has amplified what the Fed's facing. So in many ways, the doubts at the very core of the Fed's reaction function at this point.
There seems to be some confidence that inflation is going to come down. There seems to be a debate about what price we'll pay for it. Can we talk about the thing we're confident about? Do you think we should be confident that inflation's going to return to 2% anytime soon?
I think there's a really good chance that that's going to be the outcome. The question is, what's the time frame for that, right? The Fed's in scope for that to happen over the course of the next several years. If you look at market pricing is exceptionally confident that that will happen as early as the end of this year, beginning of next year, if you look at CPI swaps. And so the direction of travel, in my mind, is clear. The Fed's conviction around bringing inflation down to 2% is very clear, but the timing is a huge question mark.
There's one other inconsistency, something I struggle to reconcile. We've priced in all these rate cuts. At the same time, people have this view that we get this soft landing. Why would the Fed cut rates in a soft landing scenario?
If you look at market pricing, it's essentially a probability-weighted view of the world, right? And so the Fed cutting 25, 50 basis points before the end of the year, there's a much higher probability that the Fed's going to cut 100 basis points if there is an accident, or cut 0 if inflation is sticky. And so what you see in market pricing is a weighted average of that. Now, will the Fed cut in the event that there's a soft landing? Really what matters is that they have conviction that inflation's coming down. If inflation's heading down towards 2%, rates at the moment are too high. If it's stuck above 2%, let's say 3.5%, right now it's running closer to 4%, the odds that rate cuts will be on the horizon this year are quite low.
What kind of accident would be enough to actually make the Fed cut rates?
In my mind, the labor market is key to this question. We are starting to see some signs of slack at the margins of the labor market. Wages have started to slow. We're seeing unemployment claims creep up, but so far it's been a picture of overall health. The labor market tends to turn very quickly. And so if we start to see the unemployment rate creep up, if we start to see wages decelerate towards the end of the year more than they've done over the course of the past 12 months, that would be a really strong signal to the Fed that they have done enough.
But that's not an accident, right? I mean, that's basically the design, is to get unemployment just up a bit higher, or at least so that there have some slack in the labor market a little bit more to bring inflation lower. If this wasn't enough to get the Fed's attention, I mean, yes, they did flick at the Silicon Valley Bank and what happened there, but it seems to be contained. If it really is contained, has the idea of an accident been sort of taken off the table?
That's a really good question. In my mind, the accident really comes through the lens of financial conditions. So if there's a disorderly widening of credit spreads, a disorderly change in the liquidity conditions, particularly for treasuries, you will see the Fed act and at least bring forward the easing cycle. Now, are those things predictable? Mm-hmm. No.
Let's do a basic fixed income Monday morning retail question. Now that I garner a coupon, nominal or real, can I own longer duration, grab the coupon out there, I don't know where that is, and wait, and even if I see price go down, I've still got that coupon? Are we back to that mindset?
I think it's very attractive. I mean, look, the key question for a retail investor is, am I going to park my investment in cash, which is now quite attractive, versus longer duration assets, whether it's high quality credit or treasuries? And we think that extending that duration right now.
Give me a number, roughly.
Anywhere between 3.5% and 4% on the 5-year note is quite attractive. And then you can add to that if you're looking at credit.
This is really important, John. The idea here of a pro like Ed is looking at a 5-6 year duration, where in muni bond land, 20 years is short term because you're grabbing.
If I can take one thing away from this conversation, Ed, what you said about the market pricing cuts being a weighted probability, a weighted average of a range of views, I think is so important. Gershon Distenfeld of AllianceBernstein talked about exactly the same thing. This means that either we've priced in too much or not enough. And Lisa, I think that's the problem that Neil Dutta basically has over at REMMAC. And Neil's saying the same thing. And Neil, by the way, is much more constructive on the economy than a lot of people out there saying recession. He's basically saying that if you do have a financial accident, which is what you're talking about, Ed, they're going to go way beyond what's priced in. But if nothing happens, they're going to hold and do exactly what they say. So I wonder, Ed, how much we're making of this gap between the Fed and market pricing. Do you think we're making too much of a big deal of that? The spread between market pricing and the Fed?
I think that's exactly right. It's not a big deal. I think maybe there's a little bit of a gap between terminal pricing, which is another 25 basis points of effort that the markets have given to the Fed. It's possible that they go a little bit more. Right, inflation's been moving sideways for the past 4 to 5 months. But beyond that, what markets are pricing, to me, seems quite reasonable. It probably puts the front end of the Treasury curve. It makes that a little bit rich. But the moment you get to the 5-year, you get to the 10-year point on the curve, those look quite attractive to us.
Ed, always smart. Great to catch up. Thank you, sir. Ed Al-Husseini there of Columbia Threadneedle. Lisa, what do you make of that? We've either priced in too much or not enough.
What it makes is that we're in a soup. And right now, even what people are trading in market pricing is trading around these sort of ambiguities of, we have no clue what shoe is going to drop next. And if no shoe drops, well, then we're actually in a pretty strong economy. And we could get no recession and no need, or it's just a really light recession. So it's just a messy moment where people don't know what's happening. And Peter Scheer wrote it right, which is basically road to nowhere. He's like, I'm not even angry enough to write because I've got nothing to write about, because it's basically this range-bound soup of nothingness.
Not angry enough to write is the title of Peter Scheer's research note this morning. I love Pete. Coming up, 8:30 Eastern Time, in about 50 minutes from now, we'll catch up with Dana Peterson of the Conference Board on the Economic Outlook, Tom. That's just around the corner.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Possible presidential candidate Ron DeSantis met with Japan's Prime Minister Fumio Kishida in Tokyo. It was a chance for Florida's Republican governor to burnish his foreign policy credentials. DeSantis said he appreciated Japan's efforts to boost its defenses. Japan has increased military spending, in part due to China's threats toward Taiwan. In the UK, Prime Minister Rishi Sunak's government will try to fill the void created by the implosion of the country's main business lobby. Sunak meets today with about 200 of the UK's major business leaders and investors. That comes after dozens of companies quit the Confederation of British Industry. There have been allegations of rape and sexual misconduct against CBI staffers. The U.S. reportedly has asked South Korea not to boost chip sales to China if Beijing bans U.S.-based Micron from selling there. And that's according to the Financial Times. Beijing has launched a national security review into Micron, one of 3 dominant players in the global DRAM memory chip market. South Korea's Samsung and SK Hynix are the other 2. LVMH has become the first European company to have a market value of more than $500 billion. A boom in sales to China and a strong euro have boosted the luxury goods maker. LVMH's rising value has turned CEO Bernard Arnault into the world's richest person. According to the Bloomberg's Billionaires Index, he's worth about $212 billion. And Credit Suisse reported $69 billion of outflows in the first quarter. It also took a large write-down at its wealth management unit. All of that underscores the challenge for UBS in retaining key clients and assets following the emergency takeover. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate while this is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Now that the Fed is tiptoeing through a dark room where they know there's broken glass on the floor, they're going to be a little more cautious even if they go beyond May. That for us, from a distributional sense, it cuts off the right-hand tail side of the U.S. dollar smile. So the only way to get USD meaningfully higher is starting to price in recession, and we, of course, don't think that's an imminent factor.
Luke Howard, just phenomenal, as always, over at UBS Asset Management, a good friend of ours, a good friend of the programme, of course, looking for a stronger euro, outperformance in European equities. That's where the outperformance has been. Let's be very clear about that. Against the S&P 500, the Euro Stoxx 50 since the end of September, absolutely crushing it. The equity market more broadly right now is negative 0.1% on the S&P 500. I've given you the guide for earnings for the week ahead a few times, but I'm happy to offer it again for big tech. A little bit later this week, tomorrow, Microsoft and Google. Wednesday, you'll hear from Meta. Thursday, Amazon. Next week, Tom, Apple.
I miss Luke Howard.
Luke was great. He was awesome. He was brilliant.
Well, he's always awesome. We know that. I mean, he's the youngest, brightest guy we know. But this may be the year where the Leafs have a pulse. The Toronto Maple Leafs
to talk about that.
Are like the Tottenham of hockey.
Lisa and I maybe not
I know.
the appropriate people to discuss it with him,
You're disappointed that you weren't there.
They've taken 2 from the hugely wonderful Tampa Bay Lightning. Good morning, Jeff Vinnick. And the answer is maybe this is finally. I don't think Luke has ever seen the Maple Leafs win. I mean, I don't think.
Well, he was happy. Let's put it that way.
I think.
And the Knicks got it done yesterday, right?
The Knicks did, yes.
The Knicks. You're calling them the Knicks?
Yeah.
Okay, good.
Just for
all right.
It gets very riddled.
Basketball experts around this table as
Thank you. Well, we're just so knowledgeable with it. Let's go to someone who knows what they're talking about right now. Stephen Englander with us. We had Jens Nordvig with us earlier, and we go stronger with Stephen Englander, global head of G10 FX research at Standard Chartered Bank. Stephen, I got to go to 60,000 feet. I saw it in The Economist this weekend. It's out there. The death of the dollar. You were a child, and we were talking about the death of the dollar. How close are we to where we would lose the power of the dollar as a controlling exchange?
Well, first I have to talk about important things. Since I'm from Montreal, I think the Maple Leafs have gotten just what they deserved for the last 30 years.
Bam.
With respect to the dollar, I think that any kind of de-dollarization is going to be limited and very slow. On the other hand, we see the business cycle turning against the dollar. We've seen European equity markets and global equity markets for the first time in years outperforming U.S. equity markets. And we do have this, concern in a big part of the world about how safe their dollar assets would be in the event that there's a geopolitical issue with the U.S. So a slow process of de-dollarization doesn't necessarily mean a slow process of dollar weakness, because the U.S. still has its funding requirements, and all you need to do is have less money coming in.
For our corporate audience who have to hedge every transaction every day for safety, is there value to hedging foreign exchange transactions right now, or is it money wasted?
Look, there's always value. There's always prudence to having some hedges on. I mean, you know, once or twice, FX strategists like me have been wrong in our forecast, more than once or twice. So I think just to lower the volatility of your earnings, you want to have hedges. But I think that even at 110, the dollar has room against the euro. The dollar has room to weaken. So maybe it's a story of hedging a little bit less. If you're at your normal hedge ratio, you don't, you know, you shade it a bit.
I'm looking at the idea of central banks and whether they turn to the dollar as a reserve currency, and sort of to build off of what Tom was talking about. There was a story in the Financial Times over the weekend about how gold purchases by major central banks have risen to the highest going back to 1967. And you can see that a lot of them are planning to continue to build gold resources. Do you get this sense that there is this sudden concern on the part of major central banks about the use of the dollar as a reserve?
Well, I don't know if it's a sudden concern. I think it's intensified. We started, like, I think about 20 years ago with sanctioning Sudan, and now the use of sanctions has obviously broadened quite a bit. I think any country that thinks that they might be on the receiving end down the road of U.S. sanctions, because it's not as if you can get out of dollar assets quickly, would sort of discount their dollar assets and try and avoid them if they can. It's not as easy as it looks, but on the margin, I think that they are looking for alternatives.
Given that, Stephen, do you think that there is a sort of weight on the dollar that hadn't been there before, that where it cannot rally quite as much in periods of global concern or recession, just simply because it isn't necessarily going to be the go-to place for all of those central banks?
Well, people toss around the word recession, and including me. What I think most of us are looking for is sort of sluggishness, maybe a technical recession, but, nothing that looks like the middle of 2020 or 2008. And with that kind of sluggishness, I think you're still going to be on the dollar weakness part of the dollar smile. But I think on top of that, you have all these other factors, including the, outperformance of equities. For a long time, the attractiveness of the U.S. equity market has been a major sort of force bringing money into the U.S. Now there may be better places to do it, in addition to the geopolitical issues, in addition to the debate being about the Fed pause and when they might begin to cut. Dollar's kind of expensive to have all that weight on it right now.
Stephen, the Standard Charter mandate is a mandate of emerging markets, the Pacific Rim. There's a whole romance to the history of the bank. Which lesser EM currency now gives me the best big figure return?
Well, in Asia, we like Indonesia, we like Malaysia, we like the high yielders. We think that those are going to be, attractive. In emerging markets, we like Brazil. In Latin America, we like Brazil, high yielders. ZAR has gotten beaten up, but it's, if the world outside the U.S. is recovering, it's likely to do better down the road.
Hey, Steve, appreciate it. Thank you, sir. Steve Englander there of Standard Chartered on the FX market. Lisa, strong euro, weak dollar's been a theme. You got back to the end of September. What were we on euro dollar? 95?
Yeah, it was
something like 95. We've been talking up cable parity.
Well, 14
pound
big
against
figures.
the US dollar.
14 big
It's a
figures.
monster move.
Yeah.
And risk has moved with it. I think that's what's really interesting. We had that stress around the end of September. Really, really strong dollar. Equity market weakness started to come through as well. And then that started to resolve itself.
And how much is this because of energy and what happened with the stockpiles, the perhaps warmer than expected winter? And how much is this just simply China reopening, putting all this money into the European economy, them being a bit behind the U.S. in terms of the fight of inflation? You put that together, it kind of makes sense.
Steve Englander alluded to it, and that we spend in the financial media, we spend most of our time looking at interest rate differentials. What's the ECB going to do? You know, the usual central bank parlor game. Steve Englander is there talking about flows of money. This is something Robert Sinch was legendary at Bank of America, and before that, Bear Stearns. And the flows of money have been, I got to buy Apple. So, you know, it's a generalization. So the money flows into the United States. Is that flow or that marginal flow broken is maybe the big question 12 months out.
I think we've heard the reference to the dollar smile a couple of times now in the last 5 minutes. We should probably get Steve and Jen on one day to talk about it, Tom, but I think we can discuss it now. On the one side of the so-called dollar smile, you have that US exceptionalism story, dollar strength.
And he's...
On the other side of the smile, you have everything really, really bad, dollar strength.
Yeah.
It's the everything else bad part of this that people aren't confident about. And I think Luke Howard talked to that. He said you can have a situation where the US growth slows and you don't get a stronger dollar because the rest of the world still is okay. If China, Europe gets into trouble, then we've got a different story. But they just don't see it happening yet, Lisa, because of the growth we've seen in China off the back of the reopening.
I'm going to say something a little sacrilegious.
Sure.
Macro stories right now, I'm having a really hard time with, because you can kind of come up with whatever macro story you want when you say things are going to be bad. Well, in what areas, right? To that point of, okay, well, if you have something that's bad in manufacturing but not in services, things can still be okay. Like, what will qualify as bad enough? So you can paint a narrative and use the data and get a completely different market reaction, and that's just mind-bending right now.
I think there's tons of narratives out there. Let's remind ourselves, Steve and Jen, iconic at Morgan Stanley years ago. He's sort of often, what are you going to call it, John? Hedge fund land? We don't see him as much. But he's talking up de-dollarization as a concept out 3 years and 5 years
I remember doing a conference with him years and years ago, and it was just an absolute clinic.
Oh, yeah.
The guy is awesome. Should try and catch up with him again soon. Drew
Next
Madison,
trip to
MetLife, coming up from New York with your S&P 500 negative about 0.1%.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live, and it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes, or yes. Not keeping, look, people have conviction, or they invest for the, if they invest for the right reasons, just keep at it.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
There's a lot of fears of the carryover from the banking crisis and things were going to fall apart. That's not the case.
I think overall we're starting to see some stabilization.
Our view is that the Fed is going to be torn, really torn, between inflation north of 2%, but the unemployment rate starting to rise.
When I think about the Fed, I mean, they're closer to the end of this than not.
If the Fed's cutting, the economy is not so good.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on television and on radio. A Monday towards an earnings season, towards a Fed meeting along the way. And John, I'm sorry, I look at this Monday. It's a 12% organic growth. What will be the other surprises this week in earnings?
Well, there's tons of earnings to look ahead to. Thank you, Stuart Kaiser of Citi, for this number. More than 40% of the market cap of the S&P 500 reporting this week. Mega cap tech, a part of that story. I am interested, though, in one specific thing around the earnings story. Putting some numbers on the drama of the last quarter. We did that with Credit Suisse a little bit early this morning. We'll do that with UBS tomorrow. First Republic after the close, Tom. The last significant name, I would say, from the drama of the last 3 months to report earnings in the banking sector.
And the Keefe Bruyette Index clearly shows regional bank tension. I looked this morning at the big cap equity bank chart and the regional smaller bank chart. Two different worlds.
There are all these little inconsistencies, TK, that don't really stack up. Brownlow, you talked about a low VIX. VIX has recovered, it's come in. Yet you also talked about the financials. They haven't recovered. They haven't rallied in quite the same way.
And as Tom pointed out, particularly the regionals, even after you've gotten numbers, as you've said, John, that haven't been really that terrible. There haven't been massive, horrible surprises that weren't already priced in. But on the flip side, there wasn't anything to really give people optimism that the business model wasn't profoundly flawed at a time when these banks would have to pay up for deposits.
We're going to reset, and for all of you, we've got a guest coming up here in moments. It will really help with your reset of your 201k if you didn't participate in this market. John, I didn't realize walking in the door after my sojourn, this idea of 12 months trailing Standard & Poor's, Dow, and NASDAQ. I think we're all set. I'm set with a gloomier outcome than what the number really was. SPX was negative 27% at the bottom, now negative 3%, Dow 0, flat. NASDAQ has really come back near an SPX 1 year trailing.
Oh, the rally has been phenomenal. Huge. Looking at the NASDAQ year to date, Tom, we've seen a massive move on the NASDAQ year to date. Year to date, currently, I think we're up about 15%. You look across Europe, though, CAC 40. How many times have we talked about that? I don't think you and I have talked about the CAC 40 once in about 5 years, Tom. Maybe a couple of times. We've done it a couple of times this morning. LVMH makes up more than 10% of the index. LVMH earlier this morning, $500 billion company. First time we've seen that in Europe. CAC 40's up 20% year to date.
We inform on Bloomberg Surveillance, and we do this with the idea of the CAC 40. I didn't know it only started in 1987. It was an index in Paris before that. And then they went to some form of like digital trading or whatever back then. And I can't say the French name, the Cotation Assistance with accents we don't have en contenu. How am I doing there?
Don't ask me.
I just want to point out how connected this could be, that we're talking about the CAC 40. We're talking about French luxury companies and how they're doing tremendously.
And Macron's in China,
And Macron's in China.
I don't think it's
having, a really nice discussion about trade with Xi Jinping. You put these things together, I mean, are they totally separate? I don't think so.
I don't think they are at all.
Switch gears quickly here before the data check. Jens Nordvig, Stephen Englander, back-to-back. That's what this is about. John, on the euro, can we get belief? Jordan Astavila at another bank, he is looking for a 115 euro.
Let's be clear. We've got belief. We've got the belief. Yeah. It's about whether the moves materialize. So far, they have. But we have to go back to the conversation that Ms. Mateka started at JP Morgan this morning. Are we approaching that point where it's time to kind of close out the move, Tom? Close out the position? You've seen a massive move. Consensus overweight Europe, we get it. Consensus long the euro, we get it. We've seen some big moves already. Is it time to close the position?
Weekend euro yen through 148 this morning, John's a benchmark for me.
Let's run through it on the S&P 500, negative 0.1% on the S&P futures, just a little lighter, no drama here. Yields come in 3 basis points, your 10-year 354. Talked about a euro through 110, just about holding on to 110 right now. That currency pair, positive 0.1%. And crude back in the 70s. Not really doing much this morning, 77.80, Tom, on WTI.
Right now, and this is lean forward for Global Wall Street and those of you that need optimism. Drew Mattis joins us, Global Economics and Market Strategy Head at MetLife Investment Management, iconic with Maury Harris at UBS for years, with an optimistic tone on the American economy. Buried in your note, you go to the heart of the matter. Olivier Blanchard says this in my book of the summer. Paul Romer, the great Nobel laureate, is big on this. And the Nobel laureate Drew Mattis mentions it as well. We underestimate the technology overlay of the United States of America. You have a more optimistic tone on risk right now, and part of it's because of our technology leadership.
Well, I think so. I think, so first of all, we have a recession to get through. I mean, I think everyone who was saying there wasn't going to be a recession this year is now finally kind of throwing in the towel on that. It seems obvious that there's some downward momentum in the economy. The question is, when we come out of it, what's it look like and how good could it be? And what I've been arguing is actually it could be as good as what we saw in the 1990s. I think you're going to see, when we come out of this recession, you're going to see a return of a higher labor force participation rate. You're going to see older workers returning. You're going to see workers staying in the workforce longer because they're going to be healthier. And you're going to see the productivity gains from all the technological advances we've made during COVID.
What do you think the catalyst to return will be?
I think the catalyst to return will be a couple things. One is people are trying to figure out what to do with 35 plus years of retirement, right? I mean, so as lifespans continue to kind of improve, do you really want to sit around the house for the last 35 years of your life? I think more and more people are going to say the answer is no. Secondly, what can you do with the money you've saved for 35 years? Well, you can do a lot more of it in 25 years than, if you work an extra 10. And I think people are going to generally be healthier. I think we're seeing significant improvements. From the time I started work, people were promising biotech miracles. And it was just like, oh, yeah, there's going to be a biotech miracle next year. Oh, no, maybe the year after. We actually saw some of them. And we've all been so distracted by everything else going on in the world that we haven't recognized the fact that there have been significant improvements in how we're able to actually change kind of, what goes into your body, how to fix things, and how to kind of make people healthier.
So people will live longer.
Yes.
And they're all faced with a decision. And clearly it's not going to be golf is really hard and I can't play golf. You think it's going to be something else. I'm trying to work out why it wasn't 5, 6, 7, 8% inflation, why it hasn't happened in a major way over the last couple of years. Why is that?
I think, one of the reasons we haven't had inflation was because no one expected inflation. So inflation is one of those quirky things. If no one believes inflation can happen, then it won't. And it really takes a mindset change to allow for inflation to occur. And this is why hyperinflation happens in certain countries, because people just are like, it's not unusual for the price of something to go up 1,000%, right? But, what are we seeing now? Actually, we're seeing prices going down in a lot of categories. I think, our flirtation with kind of high inflation is coming to an end. I think before the end of this year, we will be at a level that's pretty consistent with long-term inflation expectations that the Fed wants people to have. And we will be able to kind of move on and maybe learn from the experience. Hopefully the central bank will learn from the experience that the next time inflation's running really hot, maybe continuing to ease is not the best idea.
Given the fact that yields are a lot lower than where they were, say, 2 months ago, but still significantly higher than they had been over the past few decades, are you just going heavily into fixed income right now, saying that this is a great time to capture these yields if this is simply a flirtation with inflation?
I think you actually still want to wait a little bit. What tends to happen is you want to basically start looking at riskier assets when everyone else doesn't want them, right? And so that tends to be at the start of a recession, when people are trying to kind of, the people who were convinced themselves that a recession could never happen, unemployment could never move higher, that's what you want to buy when they're selling.
So what do you buy right now? I mean, did you sort of stay in the big tech that's done the best?
I think you actually just, like a squirrel waiting for winter, you just gather your nuts and pile them in a tree. So, cash looks pretty good right now. I don't think now's the right time to take a huge amount of risk because I think prices will get a little better as it becomes more obvious that recession is coming. You're seeing hints of that, right? You were talking about the VIX earlier, Jonathan.
Sure.
Part of the reason the VIX is going down is because everyone's coalescing around a view. And if there's not a dispersion of view, then the VIX actually begins to calm down a little bit. And so the view is actually, congealing, I guess is probably not the right way of thinking about it. But the way I cook, it's probably the right word to use.
Defense and playing defense. How expensive is that getting?
Well, I mean, it's not cheap. But at the same point, you can play defense actively or you can play defense passively. And so the cash idea is playing defense, passively, and you're actually getting compensated for it.
Drew Mattis, MetLife TK. Great to catch up with Drew. Always is.
It's a bigger view. I mean, it's the economics of Drew Mattis combined over to the market strategy of it, what it means for equity. And, when I look at MetLife, it's like a longer-term view. Their idea of short-term is 3 years. And that's not something we're used to in financial media.
Back to the 90s, I wanted to put that together with what we heard from the IMF last week about returning to pre-pandemic interest rates, Lisa.
And this is where some people are. You wonder how much this is actually baked into market expectations in terms of how much disinflation has to go, and then going into the sectors that benefit the most from ultra-low rates on that bet.
And people are still talking here, days on, almost weeks on the IMF 5-year view.
I know.
Of economics. I mean, it captured the attention of optimists and pessimists alike.
It was a bizarre meeting, wasn't it? In
yes,
Washington?
that's an act. I would say that. If the managing director was sitting here, I would say it was a bizarre meeting. How do you move forward to Marrakesh in October? And the answer is they've got to reset, and of course the events will be so much of how they reset, particularly with frontier economies that are so
We need to reset as well, looking ahead to the tech earnings later on this week, and then on to next week when we get a Federal Reserve decision and a payrolls report as well for the United States. We're going to be catching up in about 20 minutes' time with Dana Peterson, the chief economist at the Conference Board. Looking forward to that conversation. Before we get there, here's a snapshot of the equity market for you, just briefly on the S&P 500. We look at a little something like this. We are negative by not even 0.1%. Yields are a little bit lower by 3 basis points, 353.94. For those of you looking for Fed speak, there won't be any. Yes. We are in a quiet period for the Federal Reserve.
Is there an auction?
And for those of you tuned in all morning wondering why I'm repeating that, it's because we're so happy about it. Just so happy about it. From New York City, we complain if they didn't speak. We complain when they do. This is Bloomberg Surveillance.
That's like our tag.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy says the chamber will pass his $1.5 trillion debt ceiling increase this week. Still, Bloomberg's learned that McCarthy hasn't yet lined up all the votes he needs. McCarthy told Fox that President Biden must negotiate in order to avoid a U.S. default. Last week, the president called the Republican plan wacko. Another blow to France's President Macron in his push to enlist China's help on the war in Ukraine. China's ambassador to France told French TV that the former Soviet states don't have sovereign status as independent nations. Those comments triggered furious reactions, especially in the former Soviet bloc countries Estonia, Latvia, and Lithuania. China has now backtracked and says it respects the independence of those countries. In Sudan, the international effort to evacuate diplomats and other expatriates picked up over the weekend. The U.S. and U.K. militaries were able to airlift their officials to safety. A temporary ceasefire between Sudan's army and the Rapid Support Forces militia that has battled since April 15th appeared to have failed. Coca-Cola has posted first quarter revenue growth that beat estimates. Consumers were willing to pay higher prices for Coke sodas, juices, and energy drinks. In North America, the average price across a mix of products grew by 11%. And it's the end of the line for Bed Bath & Beyond. The home goods chain will close all of its stores and liquidate inventory over the next 2 months. A turnaround attempt failed, leading the company to file for bankruptcy protection. Bed Bath & Beyond employs about 14,000 people in the U.S. and Puerto Rico. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Earnings season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The bottom line speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Just about every single regional bank increasing their provisions for credit losses. And some of them had even released them a couple of quarters ago. And so that's certainly a big sign that all of these banks are preparing at worst for the beginning of a recession or at best for a softening of the economy.
Things aren't great. They just aren't terrible either, so it depends on what you expected to begin with. As always with earnings, that was Myra Rodriguez Valladares of MRV Associates, live from New York City, going into a big week for earnings. Bank earnings a little bit later. First Republic, the one to focus on. We'll get to that in just a moment. Then on to tech through the week. Going into it, your equity market really not doing much last week and this morning. Last week, I think negative 0.1%. This morning, negative 0.1%. Yields down 3 basis points, still in and around 350. Dare I say we've stabilized a little bit, Tom?
Yes, yes.
In the market.
Across
just
asset,
a bit.
looking at equities, bonds, currencies, commodities, it's not a snooze fest because the news flow is extraordinary, but stabilization captures it perfectly. Maybe I'll look at dollar Mexico. 18.03 shows you that stability this morning.
Looking forward to the earnings a little bit later. First Republic had a really difficult first quarter. We'll put some numbers on that difficult first quarter, Tom, this afternoon.
Well, why don't you bring in Herman Chan? Let me tell you who he is, folks. You want to lean forward on this global Wall Street. He's the Bloomberg Intelligence on regional banks, but far more, John, this is a guy with multiple bank experience, including the privilege of working for M&T Bank, Mr. Wilmer's shop of Buffalo, New York. That makes him knowledgeable like we aren't.
Herman, this is a pleasure. So give us some knowledge. First quarter, terrible for First Republic.
That's right.
Face some real existential risks, some panic there at times. Put some numbers on it. What are you looking for a little bit later?
Yeah, sure. What we're looking for is more on the guidance because we know the first quarter is going to be a challenging quarter for them. What's happening with the deposits? Have they stabilized going towards the end of the quarter? And what's their plan? Because they need a way forward if there's a big hole in their balance sheet. Are they going to be selling some loans and assets to shore up and resize the balance sheet? Are they going to look at other strategic opportunities? So there's a lot of questions heading in the quarter, and management has an opportunity to answer those.
Give us a window into management. This was in the zeitgeist this weekend, in that a bank blows up, the old guys go out the door, and they literally go out and find, I guess, unemployed executives who are good people, and the new executives on the block come in to try to right the ship. What do they do with a bank they don't know anything about? The relationships they don't know anything about.
Yeah, the folks that you're talking about, former CEO of Fifth Third, he came in to shore up the Signature Bank. So there's a Rolodex of former CEOs that are out there that the FDIC kind of has on hold to come in and take over and lead an institution.
For the younger of you, a Rolodex is a little turny thing you have on your desk with names in it. You're too young, John, to remember.
No, I remember the Rolodex, Tom. I was born pre-smartphone. I was there, lived it. Thanks, though, TK.
Thank you.
That was helpful. I will say, though, I did read that story about the Rolodex of former bankers. As we parse through some of the earnings, I am curious about how many of these banks are going to pass along the interest rate increases that they're seeing from the Fed to depositors.
Right.
And there was this one study done by Goldman Sachs that was published over the weekend where they said that every 10% drop in bank profitability reduces lending by 2%, and that this could potentially accelerate in a massive way due to this deposit beta.
Sure.
What are we seeing?
Yeah, so we're talking about deposit betas that prior to the SVB fallout was closer to around 35-40% of a all-in cumulative beta through the cycle of Fed rate hikes. So now the banks that we're covering are talking about 45 to 50% of the pass-through of the Fed funds to their depositors. So that just means that funding costs are rising and will continue to rise, and net interest margins are narrowing. So it does affect the profitability of these regionals, and it's something that we're watching really closely.
It's a squeeze on both sides, right? They're having to pay up for deposits, and at the same time, they're struggling with some of the loans that they have on their books. About 40%, I believe, of the smaller bank loan book is commercial real estate. I mean, how much are you getting a sense of what the health underpinning that really is?
Yeah, so on the loan side, there is some marginal concern that the commercial real estate exposure and office exposure will create some loan losses for the group, but it's going to be elongated. It's not going to happen overnight. It'll be a couple years because these loans do mature on a rolling basis. A couple of banks did raise their guidance for loan losses for the year. So the pressure is starting to come to fruition, but it is something that seems manageable at this point.
John, it's on the Goldman Sachs website, the Marcus website. Marcus, 4.75%, 12-month CD. Chase, next to nothing. Citigroup is less, 4%, 4.05%.
Yeah.
Bank of America, less than nothing. I mean, there are visibly out there Monday morning, if you don't know what to do with the next $10,000, a huge differential.
Two-tier banking system. And I don't think JP Morgan and Bank of America are going to even try.
I would
to
agree.
compete. They talked about those new deposits coming in last quarter and called them flighty. It was almost an expectation that they were just going to go away again and weren't going to stick around for long because there was concern underpinning those deposits that came in about return of capital. And then once they start to think about return on capital, it's just going to go somewhere else. Herman, can we finish with some scenario analysis, perhaps unfair scenario analysis? If one of these major banks, one of the major banks that Tom just mentioned, wanted to buy First Republic, how do you think that would go?
Yeah, it would need the regulator's blessing because they tend not to let a large bank like JP Morgan or Bank of America acquire regional banks anymore just because of the sheer size of these trillion-dollar balance sheets that they operate. So if First Republic were to be acquired, it would be a regional that would take it over, presumably. So that's the base case.
I can understand why the politicians would be unhappy with it. Why would the regulator be unhappy with it now? I know why they weren't previously, but right now, would they be okay with it?
Right. It's more of an issue with the global large banks that they don't want to make them any larger. And
don't we like that now, though?
I guess we do from a certain extent, but there are regionals that have the balance sheet to acquire them, so that's what we're looking for, if that would be the case.
Any names in mind?
I don't want to presume at this point, but there are a number of large regionals that do have the balance sheet and the capacity and the magic surveillance to absorb a bank like that.
Pre-pandemic, JP Morgan, 2.7 trillion. I think that's right. Pre-pandemic, 2.7 trillion total assets. It's gone up $1 trillion to 3.7 trillion. So they're getting bigger whether they acquire or not. I mean, these guys are embarrassed by their success. It's been one of my themes on these banks.
Well, honestly, the good news is you can speculate on how much the regulators don't want the big banks to take over the regionals, but the big banks don't want to take over the regionals because why would they have to take on the liabilities if they get the deposits anyway, which is essentially what JP Morgan did in this previous quarter.
That's a point very well made.
Thanks. I mean, I don't think they want them.
I agree.
I mean, no offense.
Got to do a bit of scenario analysis now and again, though. You know.
Well, it's true. But also to your point, we like big, right? That's the theme that we keep hearing is that there is a sense that the bigger banks are going to be more successful. And suddenly in Washington, they're the white knights.
They're the port in a storm now, and they were the problem 10 years ago.
I know.
That's always the way. Herman, thank you. Just wonderful, as always. Thank you, sir. Herman Chan of Bloomberg Intelligence. In the next hour on Bloomberg TV, great lineup for you to kick off this week with so many earnings coming up through the week. Sarah Malik of Nuveen, Dan Skelly of Morgan Stanley, Mike Schumacher of Wells Fargo. We're actually going to do something interesting with Mike Schumacher. We're going to talk about the debt ceiling, and he's not just going to say, we'll see when we get there. He's got some things to say, so looking forward to that a little bit later.
Is he gloomy? Like, does he really think it's like a serious...
No, I think we've all noticed that the market's starting to adjust. Just the T-bill curve at the very front end, 1 month versus 2, 3. It's just things are starting to happen.
Yeah. You're going to visit the land of Ira Jersey on this.
The very front end of the bill curve, and then I want to talk about really how that's going to spill out potentially if that tension boils over.
Can you imagine if some of the Congress members start talking about the T-bill market? If you look at the T-bill market and the curve inversion on the 1 and 3 month, you should be frightened. Everyone else is.
You know, thank you for watching in the Philippines today. Manila, I got an email from Manila. You're leaning back like this. This is like Gather David Brinkley. This is like what Brinkley used to do.
Why are you leaning back?
He would lean back like this. Brinkley would lean back like this.
Then you're off mic if you go back too far.
Well, it's okay. It's part of it. It creates a space in the room. Thanks for watching in Manila.
In the room. Do you think people want to hear space in the room?
Oh, yeah.
I think they just want to hear.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Bloomberg Surveillance, what an interesting Monday morning. Lisa, the conversation's been off the chart. I was out. I had the plague for a couple of days. I'm better thanks to the miracle of modern science. And, I missed a lot. But as you guys said, it's a snooze fest, but it's not. The narratives are uncountable.
The narratives are specific. They are corporate specific. We're getting some actual information about companies. Coca-Cola able to pass along a lot of things. We're getting on the margins this sense that perhaps things aren't as bad as we previously thought. We're getting just some marginal regional Fed data showing that the Chicago Fed National Activity Index actually came in a slight bit better than expected in the month of March, just a touch, still down, but still on the margins. We keep seeing this, whether it's corporations or in the data.
Tomorrow, a lot of real estate. My favorite, CoreLogic, S&P, Case Shiller series. A little bit dated, a couple months behind, but we'll look for that. New home sales. And now we go to other economic data through the week. And it's a big earnings week, so stay with us for all that coverage. We're very excited about it. The tech coverage. How come the tech guys come out at 4 p.m. and the banks come out at 7 a.m.? What is that about?
It's a good question. Remember that one earnings period where all of the big tech companies came out at the same time at 4 p.m.? It's a good question. It's something that John feels very passionately about, that they should all come out after the bell and then give us time to really parse through it.
We feel that we need to parse through any good conversation with Dana Peterson, chief economist at the Conference Board, who really joins us now on the state of America. Dana, where's your GDP statistic that we're going to see this week? We sort of come down. We were all at 3.2-ish, and we've come down. Give me the Conference Board statistic that you're working with right now.
Well, we're probably looking at anything between 1.5% to 2% growth in the month. Certainly, we had a very strong January in terms of consumer spending, but then February and March were pretty pathetic. And also, we think business investment continued to shrink as well as residential investment. Of course, the wild cards are trade and inventories, which have been exactly wild.
But where's domestic final sales? If you take out inventories and trade dynamics, you get into a domestic view of Y equals C plus I plus G plus NX. And Dana, are we in domestic final sales recession now?
Probably not in the first quarter, but we do think that the second quarter, we definitely will see some negative readings. Certainly, that'll be negative consumer spending, also business investment, and of course, residential investment.
Dana, have you been surprised at consumer confidence hanging in there, at the fact that the economic data has not turned around more than it already has?
Well, our overall measure of consumer confidence continues to just kind of move back and forth. It's definitely down from where it was at the peak last year or even the year before. But still, no, when you look at expectations, consumers still expect a recession at some point, and they've been signaling that for the last 12 out of 13 months. And so something is about to happen. And certainly when we ask CEOs, they continue to believe that there is going to be a recession. It won't be long and it won't be deep, but it's going to happen.
How much is this consistent throughout industries versus specific industries giving this signal very strongly, whereas others are a little bit more iffy on just the prospect?
Well, when I look at the labor market and by industry, it's kind of split into three pieces. You have those former pandemic darlings that are not doing so well, like technology and retail and transportation, warehousing and finance. But then you have the ones in the middle that are just kind of hoarding labor and not doing anything. And then you definitely have those industries that are still adding workers, and that includes healthcare and hotels and restaurants, all those experiential types of services.
With inflation coming down, do we get an inflation-adjusted wage, however you want to define it, that's level or increases, or do we still have negative real wage growth?
Well, real wages are actually slightly positive right now, and that's because headline inflation has come off. But still, underlying inflation, less food and energy, is still pretty sticky. And again, wages are just slightly positive. So we think that with that, consumers are saying to themselves, well, at least energy or at least gasoline's not as expensive as it was. And so it's not eating into my budget as much as it was. But certainly food and other services are still pretty expensive.
I look, Dana, at the back and forth here of all the economic data coming out. I believe we have to get to a Fed meeting May 3rd. What matters for Chairman Powell and the rest of the voters at the Fed towards May 3rd? Which part of the new economic data will matter?
Well, certainly this week's GDP report for the first quarter, but also the PCE deflator inflation, whether or not we still continue to see stickiness in the core, or if it's just a function of what we saw in CPI. And also daily lending data from banks to businesses and consumers, and seeing how much that dips. Because if it dips considerably, then that tells the Fed that, well, maybe this is the last hike that they'll need to implement. But certainly if inflation continues to be a problem, we might be looking at 2 more hikes.
We're speaking with Dana Peterson of the Conference Board at a time of great uncertainty of exactly where we are in this economic cycle. And Dana, there was a lot of discussion earlier in this year about whether we'd be going back to the low-inflation, low-growth kind of environment that we had for so many years, and whether rates could go back to that in the next few years. Do you see that as a likelihood akin to what IMF was saying in the past couple of weeks?
Well, we certainly do think that growth over beyond this year is going to pick up, but still be materially below what we're used to seeing, probably closer to potential between 1.5% and 1.8% growth. And that's certainly not the 2.5% to 3% growth that we saw before the pandemic. But inflation will be tough to keep down because there are going to be these structural drivers of higher inflation. So that means the Fed will have to keep interest rates higher for longer in order to get inflation back to the 2% target and maintain it there.
What does it say, Dana, that so many people before this period of time said that this economy could not handle higher interest rates, and that suddenly we are seeing ongoing growth in the face of interest rates that are the highest they've been going back to the 1980s, and that people believe that the Fed will eventually have to cut, but you're saying not really that much given how much inflation is going to pick up. What does that mean about what the right rate is?
Well, when I look at the economy, different aspects of it are behaving differently. So I use different a lot. So if you look at the housing market, residential investment, that's really come off, and that really moves first when interest rates rise. And then business investment has come off a little bit, and consumers have pulled back on spending on durable goods, which are things that they need to finance. The last shoe to drop really is services. And I think it's going to take some weakness in the labor market, or even belief that consumers believing that they might get let go, even though they may not. And that's really going to bring things back into balance.
Dana, one final question. We've got to go to some breaking news here, but Dana Peterson, it's too important. You opened this conversation by talking about sub 2% growth. Can I assume that with sub 2% growth, X% of America is in recession? How big is that part of America that feels recession, even if the GDP statistic is positive?
Well, I think definitely people with lower incomes, because much of their paychecks get eaten up by inflation. But also we're seeing worries among people who have higher incomes, especially the middle class, because they're the ones who pay the most taxes. They also pay a lot of, in terms of inflation, they're still very much affected. And so I think it's those groups that are definitely feeling the pinch right now.
Dana, thank you so much. Dana Peterson with the Conference Board. I guess it's a roll-up, but when a stock, Lisa, goes from 5 to 8 on its way to 5 to 10, with an odd proposal of Boston's Trillium Capital over a name that we in the media know a lot, which is Getty Images. And this is the ownership of all, not all, but damn near all of the famous photos that we live with each and every day.
Just to bring you what just crossed the headline, Trillium Capital has offered a non-binding proposal to buy Getty Images for $10 per share in cash. This according to a statement that just came out moments ago. You could see Getty shares responding pretty dramatically ahead of the open, up more than 40%. And this comes at a time of a real question of how to generate value from stock images, from media content that people use on a regular basis that becomes just basically part of the framework of what we see. And yet you got to get paid for it.
You got to get paid for it. Tiny company, 100, 200 employees, whatever it is. And what's so important here, like the music copyright, like who owns Taylor Swift songs, just as one example, with these photographs, maybe the revenue growth's a little shaky, but their EBITDA margin down the income statement is Apple-like. It's 30%, 32%, and they're even taking out a net income now of 10 cents on the dollar is modeled out with a positive free cash flow. Elon Musk would love an income statement like that for Twitter. It's not there.
Well, what I find compelling too is this idea that a lot of hedge funds and just firms in general, investors, are looking for ways to find incredible value in old companies. And I say old because they really made their mark in a different kind of model for media. How do you get paid? How do you generate capital at a time when people still rely on these images? But are you getting used to getting things for free online?
Yeah, we're going to have to see, and we'll have much more on this. It's a small transaction, but I think it's just emblematic of the ownership of digital product today. They don't own this photo. This was just out on Twitter from Mr. Kawa, who I believe attended Friday as well.
Yeah.
It's birthday for his dog. This is not owned by Getty Images, but maybe they'll want to acquire this. The level of cute here is off the chart. It's Mahavlich, and of course, the beast is named after the great Frank Mahavlich, who not only did hockey, but became a senator in Canada as well. He was, in my youth, Frank Mahavlich was truly one of the best. And Mahavlich is 3 years old today, and we say birthday greetings. And I suggest Getty pick up the rights to this photo.
It's basically an archetype of cuteness. That's the advertising pitch for Getty Images to pick it up.
Yeah. Can you imagine when Luke starts talking bonds and fixed income dynamics? I mean, Mahavlich must just like run. Anyways, happy birthday to Mahavlich the Beast as well. Futures at -6, Dow futures -50. The VIX, again, under 18. I think it's a bull market VIX. We haven't had anybody tell me today that we got a bull market, Lisa. We're at 17.56 here. Is it a bull market? I can't get a straight answer.
It depends which side of the market you're talking about. If you look at big tech, it's been doing really well. If you look at Meta, if you look at NVIDIA, as you mentioned earlier, if you look at some of these companies, they're up more than 70% year to date. If you take a look at the rest of the market weighted, or rather the equal weighted index, not so much, kind of more range bound.
Can we talk about something you mentioned, I think, earlier? Oil under 80. I don't know what to make about that.
Well, yeah, last week was actually a pretty significant decline, and people are expecting a slowdown despite China coming back online.
Bitcoin, same thing with Bitcoin, sliding under 28,000. John never mentions Bitcoin.
No,
what is that about?
He does not find it compelling. I think he just is not as familiar, and it's not a benchmark that most people
He should guest host the crypto show.
Oh, you can let him know that.
He'd be killer at that. Stay with us. Bloomberg Surveillance. Good morning.
Sure, he'll be pleased with taking on another responsibility. Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Well, possible presidential candidate Ron DeSantis met with Japan's Prime Minister Fumio Kishida in Tokyo. It was a chance for Florida's Republican governor to burnish his foreign policy credentials. DeSantis said he appreciated Japan's efforts to boost its defenses. Japan has increased military spending, in part due to China's threats toward Taiwan. House Republicans want to resume construction of a wall along the border with Mexico to deter migrant crossings. The Homeland Security Committee is set to unveil a bill today. It would require spending for border infrastructure and technology and would boost the Border Patrol from 19,000 agents to 22,000. The foreign minister of Ukraine has made an urgent appeal to the European Union for more military equipment and ammunition. Dmytro Kuleba spoke to EU ministers by video link. He told them there is, quote, no rational arguments why Ukraine can't get modern Western combat aircraft. The CEO of NBC Universal is leaving after admitting to an inappropriate relationship with an employee. In a statement after an investigation, Jeff Shell said he deeply regrets the incident. He served as CEO since January 2020 and worked at NBC Universal parent Comcast for almost 2 decades. A replacement has not been announced. LVMH has become the first European company to have a market value of more than $500 billion. A boom in sales to China and a strong euro have boosted the luxury goods maker. LVMH's rising value has turned CEO Bernard Arnault into the world's richest person. According to the Bloomberg Billionaires Index, he's worth almost $212 billion. Global news 24 hours a day on air and on Bloomberg Originals, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This.
In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
We still like the tech sector because certainly the understanding that there's a lot of inventory to be worked off. The question is, can they have decent results and the markets really go down because of that? We think we'd rather ride that out and say these companies have long-term growth, they have good positions in their industry, strong balance sheets to withstand, even if we do have a deep recession.
Margie Patel, let me take a moment here. She started us off strong on a Monday here. Margie Patel is legendary in every good way at Allspring Global Investments. And I want to explain that this is what Bloomberg Surveillance is about. Lisa, this is someone who does something old and fogey, which is a balanced portfolio. But unlike no one I know, she can move from bonds to equities to dividend paying, dividend growth, and back and forth. She is the supplest person I know at actually doing balanced.
And at a time of so much gloom, she's been pretty risk on consistently and actually going more into stocks and even into some of the safer bonds.
But I really just can't say enough about the suppleness there. Speaking of suppleness, this guy leads the way. Rich Greenfield had to wear a flat coat, flat jacket, and helmet here years ago in media as a sell-side analyst. He was one of the courageous guys out there in a really vicious time for IPOs and secondary offerings and that. He's aged nicely at Lightshed Partners and joins us this morning. Rich, I got to cut to the chase. I've never seen more capital deployed and misallocated in 14 different ways. How bad will the rationalizations of labor be across all of the Rich Greenfield space?
I mean, look, the reality is, we saw a lot of what I would call overhiring during sort of the pandemic, where I think there was just this sort of, incredible surge of activity around a lot of these companies. I mean, obviously they were first depressed for like a nanosecond, and then we just saw this massive explosion in a lot of these digital businesses. And you're seeing a right sizing now. I mean, look at what's happening to companies like Meta and Google, Alphabet, et cetera. But even Netflix and others, I mean, you've seen sort of across the board headcount reductions, not because business is collapsing, but I think more than anything else, Tom, is just that they got a little ahead of themselves in terms of hiring and just brought on too many people relative to overall revenue growth.
Rich, you and your team have been leaders in trying to monitor the consolidation of what we call entertainment. I saw a photo this weekend, folks, of people buying Taylor Swift's merch, and it was like 4 miles long to buy, Taylor Swift T-shirts and coffee mugs and that. Rich, I want to talk about monopsony, or the consolidation here under monopoly and where price is set. Are we just going to have 1 or 2 or 3 entertainment vendors at the end of the day?
I mean, right now, things are pretty amazing for the consumer, Tom. I mean, yes, you have the legacy multi-channel bundle that you and I have been sort of watching melt down over the course of the last 10 to 15 years, what people like to call cord cutting. But we're really in this era now of where the consumer is in the driver's seat. I mean, think about what used to happen in the cable and satellite world. I mean, having to wait, call up to change your service. Someone had to come out, swap out a box. Like canceling was a pain in the neck. Nobody did it. Now with things, whether it's Netflix or Disney Plus or Paramount Plus or Peacock, all of these things, click of a button, sign up. If you're not happy with your Peacock service or you're tired of it or you watched enough content, you literally click cancel, click of a button. There's no waiting for someone to come to your house. I mean, I don't think we've ever been in a better time in entertainment for the consumer than we are right now. More content, and you're in control of what you pay for the first time.
It goes this kind of frictionless ability that we've been talking about with banking, but also with respect to entertainment. Given those options, does it make sense to you that simply cutting workers, like what we're seeing at Meta, like what we're seeing at Disney, is enough to engender a new era of growth? I'm just wondering, basically to put it more bluntly, does Meta's cutting of staff justify a 77% gain so far this year?
Absolutely. I mean, when you think about what's happened at Meta, they've, sort of gone back to what they're good at, which is selling ads. I mean, they're one of the best companies in the world for helping small businesses around the world move products off shelves. Like that is what Meta does. They are incredible at direct response advertising. Nobody does it better than what Meta does. There was a lot of distraction, a lot of focus on the metaverse and virtual reality in the future. And I think Mark very much correctly realized he needed the street support. He needed investors to believe in this story. He can still build his long-term metaverse vision, but he has to do it in line with the growth of the company. And I think that's what got disjointed. He's refocused, reallocated capital more appropriately. And I think the team has never been more focused on selling the core product. And that's, AI-driven content and AI-driven advertising. That's what's making Meta stock work right now.
Does the same kind of thesis hold true for Disney, which is, I believe, cutting about 15% of their staff in the entertainment division? Does it also give the same sort of optimism?
I mean, you don't have the underlying growth at Disney that you do at something like Meta, right? I mean, the Meta story, while it's had amazing growth over the last decade, there's a lot to come. With Disney, the challenge is really threefold, right? We're trying to figure out, what do you do with Hulu? They've got this sort of extra streaming service. Don't know whether the, sort of NBCU news over the weekend changes that process or at all. But you've got Hulu situation. Then you've got, what do you do with ESPN? As Tom pointed out, the cable network business is not exactly a growth business anymore, and sports costs keep going up. So what do you do with ESPN? And then the big problem, honestly, that the two of you, should think about is the Disney content, that engine of growth, that really that is the lifeblood of Disney, really hasn't been working over the last couple of years. Marvel and Lucasfilm don't look as strong. They look a little tired. And the animation crown, I mean, we're all talking about Super Mario Brothers. What was the last time you were talking about a blockbuster Disney animated title? Iger's got a lot of work. He's got a lot of work to do across Disney's businesses. He's obviously incredibly talented, but he's got to figure out all three of those big issues, as well as find a successor in the next 18 months.
Rich Greenfield.
That's not easy.
Comment, Rich Greenfield, on what I saw twice over the weekend was his fondest desire of Tim Cook to the rescue. And it can be Apple, Disney, Apple this, Apple that, whatever. But in your world, there seems to be this savior transaction for troubled companies that Apple would buy you. Why would Apple buy any of this stuff?
Tom, I don't know. I mean, why would you want to own cable networks that are disappearing? Why would you want to own all of these assets when Apple has enough capital? They can make movies, they can make TV shows, they can hire the best talent. They essentially, if they want to become HBO over the next decade plus, they can spend and get there. I think it'd be very hard to imagine them buying a big media company. Sure, would they love to potentially own a studio if you could just buy a studio? But every one of the other assets, I mean, they have MLS now on Apple TV Plus. Do you need to buy ESPN and have cable subscribers to get? I mean, just buy the good stuff. Buy the actual content or invest in it, build it. I don't think you have to go out and buy one of these companies. And I think your point is well taken, Tom. way too often in this space, it's like, oh, I can't figure out a growth strategy. Maybe we'll just get bought by Apple or Amazon because they have so much capital to deploy.
Exactly. Rich, 20 seconds, your single best buy right now at Lightshed Partners.
I mean, I think, look, it's when you think about recovery stocks right now, the two that stand out that are sort of rebounding off of their lows, I think you would probably put both Spotify and Snapchat right now.
Very good. Rich Greenfield, thank you so much on entertainment. Just a great snapshot there as well. One of the big surprises here at Bloomberg is we are doing digital experiments. And Lisa, the first glow of your newsletter coming out, I didn't expect this. It's like 42 people have signed up. It's amazing how that works.
Are you calling me a digital experiment? Thank you,
You're
Tom.
a digital experiment.
If you want to sign up for this surveillance newsletter, it does come out and you can sign
Daily.
up. Bloomberg.com/surveillance. Look, this is a really, we have all these conversations and you think about how many themes people kind of play off each other. And it's great to get a sense of the great nuggets that people really parse through every day.
Let me translate the marketing babble you just heard from Bramo. It's real simple. This thing is worth looking at because of the click-throughs. The click-throughs are off the chart. Most newsletters are ego, 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 ego. You don't do that. It's like, here's what we talked about today on the show. How many click-throughs do you typically have in a newsletter?
I haven't gotten
8, 10, 12. You got
pretty small, yeah.
No, I think that's great. They're focused and great.
People definitely want to hear the interviews. It's sort of what makes
surveillance
great.
newsletter. It's a Bramo. It's a Bramo effort as well.
It's a group effort.
We can stop the show now. Futures are flat. Good morning. This is Bloomberg.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Chris, can I ask my landlord for a rent cut in the next couple months? Like, is that reasonable?
Well, I guess it depends when you signed your lease, Joe. It sounds like you got kind of one of those pandemic deals that, particularly in New York City, where rents actually fell really sharply in that first year of the pandemic. So we are really seeing the market having turned a corner a little bit over these past few months. Prices have been coming down for 4 straight months now in our national rent index.
Wow.
But, if you're still paying that late 2020 level, then you might not necessarily be eligible for a discount at this point.
Good point. All right, I have another question, which is like, so I have 2 kids, but unlike other people, I actually am cool and I don't want to move to the suburbs. Like,
this episode is just Joe taking advice on handling his rent.
I just want to point out, I really like my landlord.
You love your landlord?
She's very attentive. We have a very good relationship. So even though I started the episode saying I was anxious, if she is listening to this, I hope she hears that I really enjoy where we live and I really enjoy our the landlord.
She should factor your consistency into her pricing algorithm.
We've never been. Yes, exactly.
Excellent.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get your trading week started. Live from New York City this morning. Good morning, good morning. Your equity market totally unchanged on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, First Republic's first quarter results after the close, Fed officials going quiet before next week's meeting, and markets consider the dreaded debt ceiling X date. We begin with the big issue, wrapping up the banks, looking ahead to big tech.
This is going to be a huge week for stocks.
We've got a lot of tech companies. The biggest part of earnings season is actually going to be the tech reports.
We still like the tech sector.
We can see tech stocks up another 10% plus for the rest of the year.
Big tech is relatively defensive.
Overall, we're starting to see some stabilization.
Got strong balance sheet companies, highly cash generative, with relatively stable growth.
In terms of tech stocks, in terms of going to earnings, it's a green light to continue to own tech.
We know that tech companies have done a lot of cutting since the end of last year, early this year.
You've seen them cutting headcount dramatically.
They already ripped the Band-Aid off on guidance.
The question is, can they have a decent results?
This is when we start to find out if they cut enough to preserve their margins and to offset the declines in revenue.
Joining us now to discuss Nuveen's Sarah Malik, Morgan Stanley's Dan Skelly. Sarah, first to you. I guess we've got to understand, after a big rally year to date for big tech so far, will the earnings validate that move?
You know, I think it's going to be a lot of hit and misses there. So something like Meta, the ones that have been ahead of the curve in terms of cost cuts are probably going to have a better earnings quarter and outlook going forward. In technology, we actually like software and semiconductor companies better. So in the software space, we love the recurring revenue, the fact that they don't need to rely on pricing power to move forward, and their strong backlog. So that's our top pick coming into the technology earnings over some of the mega caps, where I think there could still be issues because they have to readjust their business models post the pandemic when they did a lot of hiring and plan for business that now has fallen off.
Just a massive week, packed full of mega cap tech earnings. Just to go through the calendar briefly for you. Tomorrow, Google and Microsoft. Wednesday, Meta. Thursday, we'll get Amazon, amongst Intel, Snap, and others too. And then next week, Apple, May 4th. Dan Skelly, going into all of that, just to build on what Sarah was talking about, have they reset things enough? Have they cut enough for the challenges that might come later this year and beyond?
John, it's a mixed bag. And so when you look at certain parts of the tech sector, sure, they've been delivering cuts since last year, and you may see some other of their brethren catch up this particular quarter. But again, it remains a mixed bag. I think a lot of the tech space has particularly accelerated and rallied off of the regional bank stress. Number one, because of their strong balance sheets, which is completely fair and efficient. But number two, the read-through, as you know, and you've talked about all morning, is that the Fed's going to be cutting fairly shortly, and we just disagree with that. So we think that duration trade has largely been priced in for the sector.
Going beyond that, it's not just about rate cuts and recession. There's some people, Sarah, that still believe in these secular headwinds. And tailwinds, rather, the cloud story for some of the big tech players. Sarah, do you subscribe to that theory that these tech names, these mega cap tech names, are divorced from the cycle, or are they more cyclical than perhaps we give them credit for?
I think they're very dependent on yields. And what you saw just recently in this month is that as yields rose, technology companies took a breather versus the strong start that they've had for the year. So I don't think it's just all about, do you want to own technology or not own technology, because these companies look very different than they did in the past. Yet during the pandemic, many of them were hiring pretty excessively for growth rates that weren't sustainable. This ranges from big flagship companies like Apple, which has to go back to its normalized growth rate that we saw pre the pandemic. Also, the cost bases are out of line for some of these companies. So I think you have to be much more selective in technology going forward. It's not just going to be about growth versus value. And I agree that also we don't expect Fed cuts, rate cuts going forward. We think the Fed likely is one and done in terms of rate hikes, and then it pauses. So it's not just going to be a trade for long duration stocks in a lower interest rate environment. You have to be much more selective in tech. And that's why we like companies like ServiceNow, that if we do go into a recession, IT budget should go more in their favor because they do help companies save money.
These year-to-date moves, the outperformance phenomenal. Meta up by 76%, Amazon up by 27%, gains of almost 20% on Microsoft, on Alphabet. For the sector, this from Elena Popina and Jessica Menton here at Bloomberg. Take a listen to this. The information technology sector on the S&P 500 up 19% in 2023, compared with a gain of almost 8% on the S&P 500. That outperformance there, the strongest start to a year relative to the S&P 500 since 2009. Phenomenal. Kaylee Lyons has more down in D.C. Morning, Kaylee.
Good morning, John. Well, that outperformance is continuing in a marginal way this morning. If you look at futures, S&P 500 futures down, while NASDAQ 100 futures remain positive. So this really just continues the trend we have seen. As you said, we've seen a nearly 20% move to the upside for tech stocks. The S&P 500 has lagged behind year to date. And then when you look at that nearly 8% move for the S&P 500, we have to keep in mind that just 5 stocks, some of which you just mentioned, John, Apple, Microsoft, NVIDIA, Meta, and Amazon, have been responsible for 2/3 of that advance in the S&P 500 this year. So it's quite the reversal of fortune compared to last year when tech was lagging hard as the Fed embarked on this aggressive hiking cycle. But it's now bets on the Fed turning around and beginning to cut this year that are fueling the rally this time in a massive way. That speculation has brought the S&P 500 Technology Index to trade at a multiple of almost 25 times future earnings. And Bloomberg Intelligence says to justify that multiple, the Fed would need to cut rates by at least 300 basis points. That is more than 5 times what the swaps market is currently pricing in. So there's a question as to whether or not this rally can continue should those Fed expectations not be met, John. And of course, we'll see if the earnings over the next 2 weeks can help justify that expensive stock.
What a busy week on the earnings front. Katie, thanks for that. Big tech very much in focus. Here's a line for you from Patrick Armstrong. If you feel safe owning it, it's probably too expensive. That was Patrick Armstrong of Plurimi just last week. Take a listen to what he had to say.
Mega cap tech and quality growth is getting quite expensive. The risk isn't that these companies miss and fall off a cliff, but they are cyclically exposed, and it may be a period of dead money where it takes a long time to catch up with the multiples that some of them are trading at now. If you feel safe owning it, it's probably expensive, and I think a mean reversion trade makes sense right now.
Dan Skelly, I'd love your thoughts on this line. If you feel safe owning it, it's probably too expensive.
John, that's the story of the S&P 500, period. When you think about 19 times forward earnings, that earnings might be 10 to 15% too high this year, the equity risk premium trading around 200 basis points, we think the overall market feels too safe. And look, to your point earlier, there's been a big rotation for the safety of technology given the balance sheets. And I agree with Sarah's comment. This is not the same sector as 20 years ago. There's higher free cash flow. There's less debt. There's more recurring revenues. And let's not forget, the dollar is going to potentially become less of a headwind. So look, those are all good things, but it doesn't prevent the fact that in an overall growth slowdown, tech is certainly going to be susceptible to that because it's beta to the market.
Sarah, you say investors should flock to safety. A question we've been asking now for weeks. What is safety? Is it mega cap tech? Is it European luxury? What's safety to you?
Well, I think what investors are worried about with the markets is whether this is the calm before the storm. So before we go into safety, let's talk about a couple of reasons for the bulls and for the bears. You know, what the bulls are excited about is that Q1 earnings look pretty strong. The VIX is under 17. Things look pretty calm out there. But a couple of things bears are thinking about is that we're at 13 months after some significant rate hikes. What does that mean for the economy? And also a much tighter consumer credit cycle. What does that mean for the consumer? So when we talk about safety, we look for companies that are consistently growing their dividends. They have quality balance sheets, provide some income, tend to be lower volatility. They should be more resilient during a recession. And then another area we like, which doesn't really always make you think of safety, is emerging markets. We just talked about the weaker dollar potentially going forward. Also, a lot of EM countries are further ahead of the U.S. on the curve in terms of tightening, and they're even loosening. Valuations are much stronger. much more in our favor in emerging markets. That's another area that we like, where you can get a little bit more bang for your buck.
You're both on the same page when it comes to EM, emerging markets, and I think a lot of people on the same page when it comes to international outperforming, specifically Europe. Europe overweight versus, say, the United States. Mislav Matejka this morning over at JP Morgan writing the following: we note that Eurozone valuations versus the US continues to screen cheap, but it appears that the consensus call these days is to be overweight Europe versus the US. They say this: we are remaining overweight Europe versus the US for now, but we think that the time to take profits on the trade is approaching. Dan, are we approaching that point right now?
We're getting there, John. And look, this is a call that Morgan Stanley made back in the fall to favor East Asia, to favor EM, to favor Europe. And look, we don't think the magnitude of the outperformance continues from here. Let's face it, PMIs have surprised to the upside. Europe got through a very mild winter, and so that energy depression did not happen. And then China's been reopening, of course, in fits and starts. So you've seen that outperformance over the last 3 or 4 quarters. We don't think the magnitude repeats from here for the rest of the year, but you're likely to continue to see some marginal performance there.
Great note just popped into my inbox from Savita Subramaniam over at Bank of America and the team, who say the following: we see 10 reasons for upside risk in stocks versus bonds and cyclical sectors within the S&P 500 this quarter, including bearish sentiment, a widely expected recession, active funds purging cyclical positioning, dry powder in private equity, downward pressure on the equity risk premium, and seasonal market trends. Sarah, I'll go through that again if you want me to, but from what you heard, what do you make of that call?
I think generally we prefer fixed income over equity at this point. Mostly it's because we talked about some of those headwinds for equity, and it comes down to valuations. The S&P at 4,100 and change is basically pricing in a soft landing, and that's a narrow path, and most likely we get a mild recession. Now you go over to fixed income, high quality, high yield fixed income, BB rated corporate bonds. You can get 6+% returns, even up to 8% returns. To us, that's very attractive in terms of getting higher, reaching for higher yield, but also taking a little bit less risk. Another area that we like is infrastructure. This is a sector that tends to be recession resilient. So the components of infrastructure like waste management and utilities tend to perform okay during a recession. So we're looking for areas which either you can get strong returns or that are more easier to survive during a recession.
Dan, I'll give you the final word here. Bank of America, they say upside risk in stocks versus bonds. Are you taking the other side of that?
We are at the moment, John, and I'm not sure what calendar they're looking at, but seasonally we know we're going into the kind of traditional sell in May period as well. And look, when we think about the overall positioning of the market, there are 3 key known unknowns that the equity market has just been too complacent about to date. Number 1, what will be the regional banks' effect of slowing lending on commercial real estate, small businesses, and the overall economy? Our folks thinks it takes 5 quarters to see the ultimate impact there. Number 2, will it take more market volatility to force a compromise on the debt ceiling? That's a very contentious argument coming up over the next several months. And number 3, and we've talked about it, and in particularly in light of number 1 and number 2, what will the Fed choose in terms of fighting inflation still, which has been sticky, or will it be favoring short-term growth and financial stability? So given those 3 known unknowns, we think the equity market's too complacent here.
We're going to talk about the banks in just a moment. Sarah Malik, Dan Skelly sticking with us. The broader equity market totally unchanged on the S&P 500 with some movers. Here's Abby.
Well, John, it's interesting because, of course, there's $16 billion worth of market cap reporting this week. Most of it is big tech, but there are other companies, too, including Coca-Cola this morning, which beat both top and bottom line estimates. Organic revenue up 12%. Public venue sales really offsetting rising costs as folks are out and back out after the pandemic. Now, Tesla, these shares are down just a little bit. They've increased their forecast for CapEx and are now budgeting about $7 billion amid the price cuts. But the big laggard on the day, Bed Bath & Beyond, it is the end of an era. The stock basically at zero. This is they filed for bankruptcy. The stores will be winding down by June 30th, looking for a buyer. More than 480 stores being closed, John.
Abby, thank you. More on that in about 15 minutes' time. Coming up, closing out U.S. bank earnings.
I think there's been a bit of a divergence in the performance across the group, but by and large, we saw regional bank deposits, pretty stable.
Earnings from First Republic coming after the closing bout. That conversation coming up shortly.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customers like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
This was a unique, I don't know how to describe it as crisis. This is a unique period in the banking system. What was incredible is you got hurt two ways because your assets on the balance sheet were getting hurt because yields moving higher. At the same time, your funding costs were going up significantly, so you were getting hurt on both sides. It's today, a lot of the assets on banks' balance sheets are yielding 3.5, and they're funding them at 5.5. That is a losing proposition.
Great conversation with the brilliant Rick Reeder and David Weston on Wall Street Week over the weekend as we put the numbers on a quarter of pain on both sides of the Atlantic. Credit Suisse lifting the lid on a grim Q1, reporting $69 billion of outflows and a large write-down at its wealth management unit. This is another battered bank prepares to report stateside. First Republic earnings coming after the closing bell, with shares already plunging 88% this year. Your team coverage starts right now with Bloomberg's Manus Krani from Zurich, alongside Shonali Basak here in New York. And Manus, first to you, putting those numbers on a grim Q1 ahead of UBS tomorrow.
They are. I mean, if you want to understand or get a whiff of what fear really is in the middle of a banking crisis, is that 60 billion walked out the door. These are yielding assets at Credit Suisse. Where did they flow to? We'll know a little bit more tomorrow when I sit down with Sergio Motti. But it could have been worse. Citi reckoned 100 billion would walk out the door. It wasn't as brutal as that. But Credit Suisse have warned, Jonathan, there will be more losses. They will be substantial. So assuming that this is perhaps the worst of the flow show, not at all. There's a goodwill write-down. There is more brutality to come here. The job of Sergio Motti, Colin Kelleher, and Iqbal Khan is to convince those clients, those families, those institutions around the world to stay the course, stay with the bank. And of course, inherent in that is convincing the rainmakers within the institution of Credit Suisse to stay the course. Their long-term incentives are worth virtually nothing. There needs to be a new plan. 9% of the assets went out the door in these 3 months. 170 billion went out the door over the past 6 months. You've got to ask the question, and I will tomorrow from Motti, which is, where is the pain point in this trade? You pay 3.3 billion for 1.3 trillion in assets, but in wealth management, where's the inflection point on the flow show? Where does this trade begin to look a little bit less like Le Ballon d'Or and something a little bit more whiffy, which
Credit
is
Suisse
unlikely,
today,
I should add.
UBS tomorrow, and in between First Republic. Manus, we've got so much to talk about tomorrow. Shonali, before we get there, we've got to talk about First Republic a little bit later.
Yeah, certainly after the market closes today, we will hear from First Republic. This is the giant in the room with the American mid-sized regional banks, if you will. Remember, there was $30 billion worth of deposits put in from the largest banks. The expectation here is that First Republic comes in with about $137 billion worth of deposits. Even that is significantly lower than the 176 that it had, almost 40 billion more in the prior quarter. Now, the question is, do they meet that expectation, and do they signal a stabilization? Remember, when we're talking about First Republic, we're also talking about worries about a hole in its balance sheet that amounts to tens of billions of dollars. How big is that? Is there some stability? Do they need to do anything else? A lot of unanswered questions alongside earnings. Do they announce anything else? Potential asset sales? Anything else here, John, to show that they can make it through the rest of the storm?
Sonali, we'll catch up with you tomorrow on that and after the closing bell a little bit later when those numbers drop. Manis, just tremendous reporting on this story from Zurich. Manis, Sonali, Francine Lacroix for that as well over the last number of weeks, the last month. What a quarter it was. The broader equity market just about unchanged on S&P 500 futures. Sarah Malik, Dan Skelly back with us. Sarah, do you have the clarity that you need on the banking sector after a chaotic month of March in a brutal Q1?
Well, first quarter actually has been a relief for many of these large banks. They've beaten earnings by about 15% on average, but we have not been positive on the banks for over a year for three key reasons. One is we expect continued net interest income pressure going forward. Because of the mini banking crisis, we also think regulations will be tighter and more competition for deposits. And also, many of these deposits has flowed to the large banks. We should start to see some attrition going forward where they start to flow back maybe to the mid-sized banks. We'll see what First Republic says later today. So if we were looking at the banking sector, which we don't favor, we're looking for well-diversified banks like Morgan Stanley or something like ING that is a high-quality bank. But that's where you need to stick in a sector that's going to continue to have headwinds.
Dan, where are you and the team on this sector now?
John, we're still relatively cautious, and we've been underweight for some time. I think to Sarah's point, not only do you have profitability issues for the regionals, they're the ones who are most exposed to commercial real estate, of course, as well, right? And so when you think about those carry trades of the era of zero cost of capital coming unwound, we are starting to see notable updates there. The second thing I'll say has to do with regulatory clarity. So when you think about the big banks, to Sarah's point, they have been cleaning up balance sheets for over 10 years. They're more exposed to a strong consumer and on the resi side of things, which has held up just fine. But when you look at, again, the regulatory environment for the regionals, it's evolving. We're going to hear in May and June new rules related to capital ratios, liquidity requirements, et cetera. And so when I think about the backdrop, John, the events of the last month or so in terms of the quick actions from the Fed and the FDIC have certainly probably been credit sensitive and credit friendly. But when you think about the equities in terms of new capital ratios, a growth slowdown, potential slowing of buybacks, there's still some pain to come, we think.
Dan, it was pretty clear in the earnings reports that we got last week, and Sarah alluded to this, that earnings were okay relative to expectations, but net interest margins almost across the board for some of those smaller banks came down. If NIMs are coming down and they're going to face regulatory headwinds in a way that you described and mentioned just moments ago, can't you just conclude from that, Dan, that growth is ultimately going to get hit because lending's going to contract?
It has to, and John, that makes sense. But even prior to the events of the last month with SVB, et cetera, you were starting to see lending requirements tighten anyway, right? So we definitely see some impact here. Again, it's a time horizon thing. We estimate it takes 4 to 5 quarters to see the ultimate impact. Ellen Zentner, as you know, who heads up our U.S. economics team, has already shaved off about 0.5 point of U.S. GDP from her estimate this year. And oh, by the way, we were not growing at a substantial level before that. So it really is, in our opinion, yet to come in terms of the growth slowdown.
So, Dan, a lot of people would say this is a feature, not a bug in monetary policy. This is the goal, and it's going to lead to lower inflation, lower growth, lower rates. And, Dan, for that reason, I want to buy tech. Why don't I want to buy tech?
Because of the sensitivity to the overall economy, it's tend to have a beta higher than the market. There are some cyclical revenue streams in there related to advertising, consumer spending, related to semiconductors, et cetera. And so, look, I think there are other areas of traditional safety that make more sense, be it in the healthcare area where you're getting innovation and growth, albeit at a much more reasonable price. You're seeing it in some of the consumer staples, including this morning, in terms of the pricing power there. So frankly, there are better areas that are more traditional areas of safety that make sense for tech at the moment. And look, final thing I'll say, Jonathan, has to do in terms of the sticky inflation, right? And so when you think about it, we've seen a tremendous amount of levers pulled to go from 9% CPI to 5% today. We've seen money supply collapse. We've seen China reopen and supply chains ease. And we've seen oil and gas way off their pre-invasion highs from the spring of last year. So that's been from 9 to 5. How do we get from 5 to 2? We don't see that happening without more disruption in the economy and the labor market.
Dan Skelly, Sarah Malik, to the two of you, thank you. Coming up next on this program, your morning calls, and later, the debt ceiling debate in Washington, why the showdown is keeping Mike Schumacher of Wells Fargo bullish on bonds.
I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Equities basically unchanged. Let's get you some morning calls. Citi downgrading First Solar to sell, seeing a challenging long-term outlook. Your second call from B of A upgrading Ally Financial to neutral, expecting net interest margin pressures to start easing. And finally, Truist downgrading Regions Financial to hold, highlighting mounting regulatory headwinds. That stock is negative 2.5%. Coming up, Mike Schumacher of Wells Fargo joins us at the opening bell, making the case for duration as the debt ceiling showdown unfolds in D.C. Your opening bell up next.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
23 seconds away from the opening bell this morning. Good morning. This Monday morning, your equity market down just 0.1% on S&P 500 futures, which is precisely where this market was through last week, down just 0.1% and going absolutely nowhere on the S&P. Hasn't felt like a snooze, it's just looked like a snooze. That's the opening bell. Switch on the board and get to the bond market. Anything but a snooze in the Treasury market over the last couple of months. Yields on a 10-year, 353, down about 4 basis points, in and around 350. Kind of stabilised around that level on a 10-year maturity. On a 2-year, through the whole of last week, Monday through Friday, the 2-year yield above 4%. And again this morning, even with yields coming in a couple of basis points, your 2-year 416. Euro dollar back through 110, 110.18. The euro against the dollar positive a third of 1%. And crude south of 80, $77 and about 60 cents. We're down about a third of 1% on the session. About 30 seconds into this session, we look like this on the S&P. On the S&P, we are totally unchanged. On the Nasdaq, we're down by around about a tenth of 1%. One stock to watch at the open is Bed Bath & Beyond. Shares plunging after a bankruptcy filing put an end to the retailer's last-ditch efforts. The company wrote in an email the following: "Our stores are open and serving customers. However, we have initiated a process to wind down operations." Abby has more. Hey, Abby.
Well, John, this is really pretty amazing. And of course, this possibility of bankruptcy, what is reality now? They did, of course, file for Chapter 11 bankruptcy yesterday. It's been speculated upon, and here it is. It has happened. The company simply collapsing under years ago, making the choice to put way too much merchandise, it seems now, and even seemed then, into their stores. Then you couple that with e-commerce and then the pandemic. That was really the nail in the coffin. Now, they will be winding down by June 30th. They are looking for a buyer. They will be liquidating nearly 500 stores. That includes the Bye Bye Baby stores. And of course, those iconic coupons, which, John, I'm guessing you don't use, but I still have some of them in my car right now. You can't use them after April 26th. So this is really the end of an era here. As for the investors, if we take a look at the chart, this is really pretty amazing, because just 2 years ago in Meme Mania, this was a $53 stock. It is now a 21-cent stock. From the peak, the real peak, down even more. But any way you slice and dice it, basically wiping out all of its market cap. A case study probably for generations to come of B-school students, what not to do here for Bed Bath & Beyond, again, filing for bankruptcy.
Always sad when this stuff happens. Abby, thank you. Lots of response on the south side. This from Piper Sandler. Expecting a number of retailers to benefit from the bankruptcy over at Bed Bath & Beyond, saying this: Bed Bath & Beyond has been a multi-year share donor and leaves $6.2 billion in sales up for grabs. We believe we're entering a new phase of retail industry consolidation, with Target and Walmart being the long-term beneficiaries. Again, Bed Bath & Beyond down by 29%. Also looking at Tesla, raising its CapEx forecast for 23 to as much as $9 billion. That's $1 billion more the company projected back in January. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. We're down by a percentage point at Tesla following the open. Not as deep a decline as we saw in the pre-market when that regulatory filing first hit. As you said, a minimum of $7 billion, a maximum of $9 billion. At both ends of the range, that is a $1 billion boost. And actually, it's something that Tesla did a number of times between mid-2022 and present, boosting the CapEx forecast at a time where they're cutting prices on EVs here in North America. They did recently just re-raise prices on Model S and Model X, and internally a view on cutting costs is a big focus. But reminder of Elon Musk's commitment to sustaining growth at the expense of margin and profit. That's something that he's been relatively clear on. And while the sell side at least are a little concerned about the impact of price cuts to product on that bottom line, at least Tesla is consistent on the view of investing through periods like this to maintain that growth rate.
The stock is down about 1%. Not a big move for that name, all things considered. Ed, thanks for that, mate. Thanks for the update. I want to turn to earnings. Dan Skelly of Morgan Stanley alluded to this one. Coca-Cola successfully raising prices and delivering strong revenue growth. The CEO doubling down on the year ahead, writing this: "We're confident in our ability to deliver on our 2023 objectives." Katie Greifeld joins us with more. Hey, Katie.
Hey, John. Yeah, people are buying soda, and Coca-Cola expects that people are going to continue buying soda. You can see that the shares are up about 1.3% right now. And if there's a takeaway, you spelled it out really nicely. It's that Coca-Cola still very much has pricing power here. We learned that customers, they're willing to pay up for Coke products at live events. and that's helping to offset some of the company's still high input costs. So you add that together, and all told, Coca-Cola beat on adjusted EPS and on organic revenue. Adjusted EPS came in at 68 cents, 3 cents higher than the average analyst estimate. And in organic revenue, it grew by 12% in the quarter. That's versus the average analyst estimate of about 9.6%. Even still, Coca-Cola maintained its full year revenue forecast in a range of 7 to 8%, John.
Thank you, Katie. Thanks for that. Just distracted by getting a little bit more information about what's happening with the debt ceiling debate. I want to get you the update with Emily Wilkins. Morning, Emily.
Morning, John. So obviously the debt ceiling debate, Republicans face a critical test this week. Can they actually pass their own plan of what they would cut to then raise the debt limit? At this point, it's not really clear that that's something that they're going to happen. McCarthy, of course, is confident, saying he will be bringing the bill to the floor this week. But you have some moderate members who have concerns. You have some hardline Republican members who have concerns about work requirements and the amount that folks will need to actually work per week to get federal benefits. And it's not clear that how leadership is exactly going to be addressing some of those concerns and whether or not they'll be able to get all Republicans on their side. Of course, the key here, the key goal for McCarthy is to make sure that he's putting pressure on President Biden to get back to the table and to negotiate with him and the Republicans. He knows that whatever bill passes this week is not going to be the final bill. We still have plenty of negotiation to do before we actually get to that X date and figure out whether or not, or what it looks like rather, to raise the debt limit.
Emily, thanks for that. Let's get to Mike Schumacher of Wells Fargo for the latest on this. Mike, I've been looking forward to having this conversation with you. It feels like slowly the T-bill market is now starting to price some of this tension in. Can you walk me through what you're seeing at the moment, Mike?
Yeah, John, it's been really interesting. If you think about the last week, tax date was the 18th, and at that point, people became super concerned about the debt ceiling. It had never gone away, but it was out of focus, I think, a bit with all the bank troubles. And now we look at the T-bill market telling us is you've got just an enormous difference in bill yields. There's a huge aversion to June, July, and August bills. Let me give you some numbers. So May 30th Treasury bill yield is, call it 360, something like that. June 6th T-bill, so just a week later, 470, 475, 100 basis points plus premium, if you will, to avoid June. Now, it goes up a little bit from there, but people are saying, don't give me that June stuff. I don't want July. I don't want August. I want to stay out of trouble.
Mike, if that tension continues to build, do you see it isolated in that part of the T-bill curve, or do you see it spilling out somewhere into the Treasury market in a way that's currently unanticipated?
Yeah, we think it spills much more broadly, John, and it's very interesting. I think Emily's point was very telling. Can the Republicans pass a bill? We don't know, and that's why people are so concerned about the debt ceiling. So if there's a lot more discussion, if this bill doesn't go through this week, I suspect you're going to see Treasury yields come down dramatically across the spectrum, so 2-year down a bunch, 10-year down 25, who knows, maybe 50 basis points if things really go off the tracks. But across the curve, it's a risk-off event in our view.
Mike, a risk-off event I think we can all agree on. It's Treasury yields going lower that you're getting some pushback on. Mike, there are some people who believe that maybe it's different this time around, that you don't run two Treasuries, you run away from them. What's your greatest pushback against that argument at the moment?
Yeah, it's pretty tough to buy that one, John. And when you think about risk-off events globally, people say, oh, gee, I'd love to avoid the U.S. dollar. I'd like to put my money somewhere else. Well, that all sounds good, but where would that be? So if you've got lots of dollars to deploy, lots of risk to deploy in general, the U.S. markets are so deep, so liquid, people can't just go running over to the bond market. The Treasury market is 10 times as big as the bond market. Can't go to the gilt market. Canadian government bond market, I don't think so. Japanese government bond market, 90% plus owned by domestics and a huge portion owned by the BOJ. So there simply is no other good spot to go. If people want to shift risk out of, take your pick, equities, credit, what have you, they really need to go into U.S. assets. So I think that's the best counter-argument.
So, Mike, do you think that politicians in Washington have the luxury of falling around on this topic?
I think it's a bit of a game of chicken, John. So you've got President Biden, Speaker McCarthy, Chuck Schumer, et cetera, all kind of looking at each other and saying, well, how close do we dare get? And our concern is that perhaps they get just a little bit too close to the edge and markets get super concerned. So there's enough latitude now, enough time, I would say, to recover and get a deal done. But the big issue in the markets is as April ticks into May and as we get toward late May, I think people get very, very concerned.
Mike, we're starting to see volatility between the bond market and what's happening in the equity market almost diverge. I'm looking at what's happening with rates volatility, and it's still elevated, and equity volatility, the VIX, so to speak, has come back down. Mike, what do you make of what's happening there?
Yeah, it's sort of a telling sign, John, when you've got really very high delivered volatility in the bond market. Now, a bit less over the last week or so, but just enormous delivered vol for weeks. Less delivered volatility in the equity market. So thinking about markets like options traders, if the 10-year Treasury yield's moving 10, 15 basis points per day, they can rationalize having implied vols very high. Equities simply have not produced that level of volatility. There's more of a wall of cash staying in the stock market right now, is my take.
Mike, we're going to continue this conversation around the Federal Reserve. Can't believe we talked about the bond market for about 5-6 minutes without discussing the Federal Reserve. Mike Schumacher of Wells Fargo will stick with us. The broader market right now, about 10 minutes into the session, we are positive by 0.1% on the S&P. On the NASDAQ, we are positive by 0.1%. Also, the Russell, just a little softer, negative. Coming up on this program, all eyes on the data as the Fed goes dark.
If data show continued strength in the economy and slower disinflation, we may have more work to do.
That conversation up next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This data-dependent risk management framework has led me to support the FOMC's response of rapid monetary policy tightening. If tighter financing conditions are a significant headwind on the economy, the appropriate path of the federal funds rate may be lower than it would be in their absence. But if data show continued strength in the economy and slower disinflation, we may have more work to do.
It's a busy week of economic data as the Fed goes quiet ahead of next week's rate decision. Investors looking ahead to another round of jobless claims, US GDP, PCE, and PMIs all on deck. Katie Lyons has more. Hey, Katie.
Yeah, John, it's a lot for the Fed to parse through when it makes its decision next week, but arguably Friday's data may ultimately be the most important because that is when we get PCE deflator as well as the employment cost index. So the Fed's preferred gauges of prices and wage pressure. It is the inflationary read that remains critical as the market expects because of ongoing inflationary pressures. The Fed is going to hike 25 basis points next week. That, though, is seen as likely the last hike of this cycle. Yes, the market thinks we have more than 25 basis points to go to get to terminal, but they don't expect that we will stay there for very long because right now pricing indicates that this Fed is going to turn around and start cutting rates by the end of this year to the tune of more than 50 basis points. This is where the other economic data comes in. Do we start to see further cracks and weakness forming and signal a softening economy that would support the case of more dovish members of the committee like Austin Goolsbee, or do they support more hawkish members like Jim Bullard who think the banking system and economy are resilient enough to take additional rate hikes even beyond May? To put it in the words of Anna Wong over at Bloomberg Economics, there's more disagreement among committee members than meets the eye. And that level of uncertainty around the economic and Federal Reserve policy is what has led to elevated volatility in the bond market. Yes, the MOVE index has come off of its highs of the year, but still we are quite high relative to history, John.
Katie Lyons, thanks for that. Appreciate it. And I couldn't agree more. There is a big divergence within the Federal Reserve that we don't talk about enough because we often talk about the median dot in the so-called dot plot and plot that against market pricing for rate cuts so far this year. If you go into the SEP, and we've talked about that a few times on this program, that's the summary of economic projections for, say, 2024. The range on rates for 2024 on the FOMC is anywhere from 3.4% to 5.6%. That's the range, from 3.4 to 5.6. Mike Schumacher back with us from Wells Fargo for more. Mike, do you think we make too much about that so-called difference between what the market is pricing, and I'll come back to that in a moment, and what the Federal Reserve is projecting?
I actually like your point on the range, John. I think that's the key one here. When you consider a turning point in policy, whether it's the Fed or any other institution, that's when people tend to disagree. It's very difficult to call the exactly appropriate time to switch from tighter policy to standing pat to easier policy. I think that's a natural time for disagreements to manifest, and that, at least is, in my view, why you've got such an enormous range for next year and why the market struggles to price it.
I think we're struggling to price in. That's the point, Mike. We often talk about the bond market, the rates market pricing in rate cuts. And Mike, I've had a couple of guests over the last week or so, Gershon Distenfeld of AllianceBernstein, Ed Al-Husseini a little bit earlier this morning, pointing out to be careful here, that this is about a weighted average of two different scenarios, the probability of one occurring and maybe not the other. Either we don't need rate cuts at all, or we need tons of rate cuts. Now, Mike, are we at this situation right now where we all talk about how much is priced into the bond market, but ultimately it's either too much or not enough?
I agree with that scenario. And basically it all goes back to the Fed leaving that punch bowl at the party way too long. And now you've got a bunch of people staggering around, and it's got to say, well, okay, we've got call it a moderate probability of a very large cut. Maybe it's 200 basis points over the next 12 months or so, or a pretty hefty probability of no move. And the market weights this, of course, and it winds up with, oh, well, if you look from, let's say, the peak this year to the ending point of 2023, it's 55 or 60 basis points. I think it's really inaccurate to consider that to be, call it 2 25 basis point cuts. It's much more the case, something goes badly wrong, the Fed reacts by going 100 basis points or perhaps more in a meeting or two, and boom, you've got a very different scenario. So the market struggles to try to assign these, call it moderate to smallish probabilities. I think it's a natural course, and I agree with Gershon and your other guests that that's the way you've got to think about that right now.
Mike, with that in mind, is it easier to think about how the longer end might develop relative to, say, the 2-year spot and into the belly of the curve?
I think it probably is, John, and we've had this discussion with a lot of clients. People will say, well, hey, you've got this big inverted curve right now between the 2-year and the 10-year Treasury or the 30-year, whatever you like to focus on. Why is that? Very different investors active on the front and the back ends, as much as I've seen that divergence in many, many years. So when we think about the long-end investors, how does their calculus change? What do they look at? Well, for pensions, for instance, they focus on the relative performance of equities versus bonds. For life insurers, it tends to be more tied to absolute yield levels. These things are not as directly impacted by Fed policy as the 2 or the 3-year Treasury. So I think you're right. It's much easier to focus in this particular context on long-term rates. Now, our view is that we're bullish for the next, call it, month or 2 or perhaps 3 while the debt ceiling drama plays out. After that, I suspect a bit more bearish, but a lot more variability in our call, and I think the market's call for the front end. For the back end, it's a much more stable environment in our view.
So, Mike, just to be clear, that call on the 10-year, that's a tactical call? It's a short-term call around the debt ceiling debate?
That's exactly right, John. It's event-driven, and event-driven calls are tough. It's not a function of core CPI goes to X, we change our call, or core PCE does whatever it might do on Friday. It's not like that. It's very much tactical, very much driven by the debt ceiling per se.
As you take a longer-term view then, Mike, of the bond market at the long end and start to think about things like inflation, I'd return back to that piece that came out from the IMF a couple of weeks ago talking about a return to pre-pandemic interest rates. Do you see it quite the same way?
No, definitely not. When you think about the IMF's view, it's taken a very, very long-term view. For us, we look at it and say, what are the motivations of the central bankers? What do they care about? They care about real yields. Real yields on the U.S. long end, in our view right now, are too low. Now, set aside the next month or 2 or whatever it might be until the debt ceiling is done. But beyond that, when you think about a real yield of a 10-year Treasury of 110, 120 basis points, that's really not going to get the job done. So we think real yields need to go up. Now, some of this happens as inflation comes down, but also probably nominal yields have to go up in time, too, to make that occur. So to push reals up to 150 and keep them there for a while, that's more of a long-term bear call. But again, we have to get through the next few months until we make that happen.
Interesting. Thanks for the clarity on that, Mike. Appreciate it. Mike Schumacher there of Wells Fargo on this bond market, making that short-term, event-driven call around the debt ceiling debate for lower interest rates, lower yields, so to speak, on a 10-year, but ultimately over the long term, elevated real yields. Right now, nominal yields down about 3 basis points on a 2-year at 4.15%, on a 10-year down about 4 basis points there to 3.53. That's the bond market taken care of. The broader equity market about 22 minutes into the session, positive by 0.1% on the S&P 500, on the Nasdaq up by 0.1% there. Big week for the Nasdaq 100. Talked about those tech earnings. I'll go back through the calendar again for you. Tomorrow, Google and Microsoft. Wednesday, Meta. Thursday, Amazon. On to next week, we'll hear from Apple. Next Thursday, I believe, May 4th. That's the same day as the ECB decision. May 3rd, the Federal Reserve. And then on to payrolls on Friday. So this week, next week, it's going to be a big couple of weeks. Let's get you some sector price action. Here's Abby.
Well, John, with the S&P 500 barely moving higher in the morning, not surprisingly, the sectors beneath not moving all that much either. The best sector is consumer discretionary, really being helped out by Amazon ahead of that big report. Services, communication services after it. Interestingly, real estate and utilities down, even with yields lower. Typically, those dividends look more attractive. Let's weigh back in, though, on this week's big tech earnings, and that, of course, is with the year-to-date moves. It's really stunning. $16 trillion worth of market cap reporting this week, and among this year's best sectors, discretionary, tech, and consumer discretionary, all up more than 15%. The worst sector on the year, financials, down just 3%, though, at this point, John.
Abby, thank you. Looking ahead to First Republic a little bit later after the close. Up next, your trading diary. Live from New York, this is Bloomberg.
large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we've seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
25 minutes into the session, we are just about positive on the S&P 500, up by 0.2%. A little more than 40% of the market cap on the S&P 500 reporting this week, thanks to Stuart Kaiser of Citi for that stat. Busy week of earnings, particularly for big tech. Mega cap tech just around the corner. The Nasdaq positive by 0.2%. That's the equity story. In the bond market, yields come in just a little bit, down 3 on a 2-year, 4.15 on a 10-year, down 4 to about 3.53, in and around 3.50. More broadly over the last week or so, finding a bit of stability there, for now at least. That's the price action. Let's get to the trading diary. First Republic after the closing bell later this afternoon. Alphabet, Microsoft, those earnings on Tuesday. Meta on Wednesday, followed by Amazon and Intel on Thursday. Plus Q1 GDP and another round of jobless claims. And finally, rounding out the week with PCE, UMich Consumer Sentiment Survey, and personal income numbers. And that rounds out the morning for me. Looking forward to covering a busy week with you all. Thank you for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
In a multi multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi
And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of two suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some passed the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
A big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions want them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop Meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, and language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
refer to the dictionary also, okay, and find out the new meanings. As well as described about. Hey, Ruchita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be in the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero. I aim to be a top-notch engineer. I am a Swero. I aim to be a top bureaucrat of this country. I'm a Swero. I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gauli Doddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. At Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities, and most of them got institutionalized now. So, for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools.
Wow.
So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change on that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university, and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand, and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park. And inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. You have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore, if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes.
This was always just kind of like a side thing. Like any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that
because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So don't forget to smash like and subscribe and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G. And it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals